Hello and welcome to the first trade on Yahoo Finance for this Friday, June 26th. I'm Alexis Christoforous, joined by my co-anchor Brian Sazi. So glad you can join us on this Friday morning. Unfortunately, more states are pausing their reopening plans amid a surge in coronavirus cases. Texas and Florida have now joined North Carolina in delaying the next phase of reopening their economies as they experience a record number of new COVID-19 cases and hospitals become overwhelmed. And new data today shows younger people in their 20s, 30s, and 40s account for a growing number of cases in states where the virus is now surging. And that has prompted renewed pleas for masks and social distancing. Now, on the other side of that pendulum, you've got New Jersey and Connecticut. Governors of both those states coming out today and saying they do plan to open public schools in the fall as those states continue to see a drop off in the number of coronavirus cases. Despite all of this disturbing virus news, we have got stock futures higher. They were higher earlier. They have now reversed course. And so now we have Dow futures off 146 points. A slight pressure there in the broader market. S&P futures down about 7, and we've got NASDAQ futures off 4 points. Now, this morning we received some new economic data shining the spotlight on consumer behavior during this pandemic. Yahoo Finance's Emily McCormick is going to break it down for us. Hey, Emily, good morning to you. I saw personal income decline, consumer spending, though, on the rise in the month of May. What can you tell us?
Well, Alexis, we saw big reversals both on personal spending and income in May from what we saw in April. So first, looking at personal spending, that rose by a record 8.2% month on month in May. Now, this was a sharp rebound from April when spending fell by a record decline of 12.6%, although what we did see this morning was slightly short of the rise of 9.3% expected for the month of May. Now, this rebound in spending is an encouraging sign for the economy, with consumer spending, of course, comprising more than 2/3 of economic activity. However, it may not prove to be sustainable because of what we saw with personal income. That was actually trending lower and fell by a near record of 4.2% for May, following a record increase of 10.8% in April. Now, looking back at that record for April, that surge was impacted by the government's coronavirus stimulus package and the increased unemployment benefits and direct checks that had been given to taxpayers. Those factors were the main contributors there. So in May, we were seeing an unwinding of those, of course, since the direct checks were not repeated. So this pullback that we're now seeing in May's income could impact consumer spending going forward. So that will be something to watch in the coming reports. Alexis?
For sure. And something that the Federal Reserve watches really closely was out this morning, the PCE index, the Personal Consumption Expenditure Price Index. That's a mouthful. What was the big takeaway there?
Well, the big takeaway there, Alexis, is inflationary trends are still muted given the coronavirus pandemic. We saw the broadest measure of personal consumption expenditures, or PCE, rising 0.1% in May over April. That followed April's 0.5% decline. Now, we saw core personal consumption expenditures, which strip out more volatile food and energy categories, rising 1% over last year, and that did match April's year-over-year increase. Now, core PCE serves as the Federal Reserve's preferred measure of underlying price trends, somewhat less relevant now, just given that the Fed has already telegraphed it's on pause when it comes to key interest rates for the foreseeable future, given the pandemic. It's really looking more at those economic impacts from the virus more so than inflationary trends sort of in a vacuum. But looking at that 1% reading for both April and May, that is well below the Fed's 2% inflation target, again, signaling that inflationary pressures have remained muted. Alexis?
All right, thanks, Emily. We're going to stick with the Federal Reserve now. And the central bank voted to put new restrictions on the U.S. banking industry after its latest round of stress testing. It capped dividends and banned buybacks until at least the fourth quarter. Yahoo Finance's Brian Chung is here to discuss. So, Brian, what did the Feds find in this analysis?
Well, the Federal Reserve does these stress tests every year, but what's unique about this year is that in addition to the severely adverse scenario that they usually incorporate into these stress tests, where they make sure bank balance sheets look healthy to sustain something like that, the actual situation that we're facing in the real world is worse than what the Federal Reserve had provided in its severely adverse scenario when it announced the stress test earlier this year. So what does the Federal Reserve do? Well, they added what they call a sensitivity analysis, where they were taking projections over what they would say would be a V or a U or a W-shaped recovery, and make sure that the nation's 33 largest banks can actually withstand the shock. Now, what the Federal Reserve found was that for the regular stress tests, all of the banks that were tested did meet regulatory minimums, but that under the sensitivity analysis, that COVID-19 specific analysis, several firms would reach minimum capital requirements, which definitely was a concern. That's why the Federal Reserve, as you mentioned, put in these restrictions on, first, no share buybacks for the third quarter, and then secondly, capping dividends. Banks can still pay dividends, but they will not be able to either increase dividends compared to the last quarter or pay out more than what would be the average of the last 4 quarters of income earned. So this restriction, again, does not restrict banks from actually paying out capital to their shareholders. That's something that Lael Brainerd, the Fed governor, had actually dissented from. She was asking the question, why allow banks to issue these dividends anyway? But ultimately, the other voters on the board were overpowering in getting this specific proposal passed. As you see on Wall Street right now, a lot of these banks not taking it well, despite the fact that the overall broad markets are down. Goldman Sachs down almost 4% in pre-market trading. JP Morgan Chase and Bank of America over 2%.
And Brian, any banks stand out to you as being notably weak?
Well, the sensitivity analysis interestingly aggregated the bank industry. The Federal Reserve said it did not want to use that sensitivity analysis and then publicly disclose specifically which banks were going to come close to regulatory minimums. But the regular stress test results did unveil firm by firm basis what the results of this test were. A number of firms, again, were close to regulatory minimums. None of them fell below those regulatory minimums. Keep in mind, banks can no longer pass or fail this test. But as you could see from the trading, Goldman Sachs, JP Morgan Chase, Bank of America, which rely heavily on those dividend payments, are definitely companies that are being watched specifically by Wall Street because of this dividend cap.
All right, Brian Chung, thank you. I want to stick with the Fed's stress tests for the banks now and bring in Fred Cannon. He is Global Head of Research at KBW, a Stifel company. Fred, good to see you here. You had a chance to look over these results. Any surprises in there for you? What stood out the most?
Well, the biggest thing that changed the most is the Fed shifted from a process where they look at stressing capital to determine payouts of dividends and share repurchases to focusing on payout ratios, earning the dividend. And that's a major shift in the thought process. And so as we think about these stress tests, we have to change our thought process to really focus on those payout ratios in terms of who is at risk from the Fed moving forward. The second issue that stuck out, as Brian suggested, is the Fed split on this. There's a significant portion of the Fed who thinks dividends should be suspended in total.
Fred, help investors understand this. If banks are not able to raise their dividends and you have a low interest rate environment, why put any money to work in these names at all?
Well, that's a fair question. I think there's a few areas where I think there's still a lot of value in this group. Number one is that, remember, this is a pro-cyclical group, and that as the Fed has indicated, when we emerge from this, there will be dividends, there will be a lot of earnings. We calculate, even in the US, if we have this low interest rate scenario for an extended period of time, our banks aren't going to be under the stress in terms of earnings and profitability that we see in Europe and Japan. So there's definitely value in this sector. They're a key component of the economy, and they're cyclical. So I think for investors who want to see opportunities, value investors, it's a group that people should certainly keep on their radar screen and certainly see some opportunities in. Also, selectively, we found some banks are in very good shape in terms of dividend payout. For example, the trust banks, Bank of New York and State Street, Northern Trust. When you look at that dividend payout issue and the stress test in those banks look very strong in terms of being able to continue to pay the dividends.
Fred, it's Brian Chung. What was interesting to me about the Fed release is that the dividend and the buyback restrictions are only for the third quarter, but the Fed said it could extend that if it wanted to. It could even do more stress tests if it wanted to, as senior Fed officials told us. I'm wondering what type of risk do you think that presents to the bank stocks in the near and medium term future, as this regime might continue, especially as we know the COVID-19 crisis does continue, more states facing higher cases?
It just means this dividend issue is an overhang on the group indefinitely, because we're going to go quarter by quarter. So that's number one. The second issue is that we have to recognize there is some politics here, and that is that Lael Brainard was appointed by Obama. She's an incredibly talented governor, and so that suggests that if we get into, in many ways, we pushed some of the dividend issues post-election, and so we can't ignore the election in terms of looking at the bank stocks.
Should the American public be concerned at all about the health of banks if this recovery is much slower than we had imagined? We were talking about a V-shaped recovery. Larry Kudlow coming out this week and saying that's still very possible. But what if we get that U-shaped recovery, a W-shaped recovery? Are the banks still well capitalized? Is that what these stress tests showed us?
Thanks for asking that, Alexis, because at the end of the day, that is the core issue. And the answer is they are well capitalized and in good shape. Most of these issues about dividends and capital are about just being extra careful about these situations. We have to look at what both the bank's capital position coming into this, 3 times the strength it was going into the great financial crisis, and also what the Fed has already done to backstop the banks in terms of the lending programs they have for all kinds of assets. The combination of the Fed actions so far and the strength of the bank balance sheets, in our view, means that we aren't facing the type of financial crisis that we had back in 08 and 09. Obviously, we're facing a very difficult crisis, but the banking industry, between what the Fed is doing and what the banks have done themselves, we believe is in good shape to get through even a U-shaped economic recovery.
All right, we're going to leave it there. Thanks so much for joining us this morning and shedding some light on those stress tests, Fred Cannon. We appreciate it.
Great. Thanks for having me on.
All right, thanks, Alexis. Let me get overseas now, checking with Oscar Williams-Grood. Oscar, U.S. markets under a little bit of pressure here. What are you seeing overseas?
Well, surprisingly, Brian, things are actually looking pretty good here in Europe to end the week. The FTSE and the CAC 40 are both up over 1%, while the DAX in Germany is around 0.75% higher. Taking a cue from that late rally on Wall Street yesterday evening, and also some comments from Christine Lagarde earlier. She told a virtual summit that we've probably passed the lowest point of the economic crash that we've seen as a result of this pandemic. However, I'm personally surprised that we're seeing markets rally as much as they are. Lagarde did say that she still has some trepidation about a second wave. A Nomura Quant's insight note caught my eye. They said that speculative investors have not lost their risk appetite, and it seems that the markets are increasingly acclimatized to the risk of a second wave, and that is certainly what we're seeing today.
And Oscar, one company that has not passed the low point is Wirecard. You've been following this story for some time. Just when you think it can't get any worse, it continues to get worse.
Well, Brian, we've all been following it over here. It takes the entire team to really keep across the amount of news that's coming out about this extraordinary collapse. The latest today is that the UK regulator has taken action to freeze the UK business, essentially ordering it to stop doing any regulated business and to keep all customer cash balances frozen. That's created a massive crisis for quite a few fintech businesses here in the UK that rely on Wirecard to do business. One of them, in fact, tweeted this morning telling customers to get to an ATM and withdraw all their money before 12 p.m. if they could. Really taken everyone by surprise. Elsewhere, the German regulator is facing scrutiny for failing to catch this massive crisis. The German finance minister suggested that BaFin, the German regulator, should be investigated and overhauled, and the EU have also suggested that a investigation should be in order. And just within the last hour, also focus falling on EY, the auditors of Wirecard. The FT report that over the last 3 years, EY didn't actually ask for any bank balance. They just took Wirecard on its word that it had the money that it did. Clearly, this story is not dying down anytime soon.
Yeah, Oscar, as we say here in the States, that story is absolutely bananas. Oscar Williams Group, have a great weekend.
Thanks,
Alex?
Brian.
I think that's the technical term, right? Bananas.
Gotta keep it clean.
Yeah. What a debacle. All right, thanks a lot, guys. Stay with us. Coming up, we're going to take a look at Nike's latest results. Sales plummeted, but are they still able to outplay the competition? We'll take a look after this. We are seeing another record surge in coronavirus cases, raising new questions about just what comes next. More than 40,000 new cases were reported yesterday alone, leading officials in both Texas and Florida to pause their reopening plans. And the White House later today is planning to hold its first public coronavirus briefing in nearly 2 months, with leaders insisting they will not shut down the economy again. Let's talk about this now with Chris Meekins. He is the healthcare policy analyst at Raymond James. Chris, good to see you. You're hearing about these states now. They're not going back into lockdown mode, but they're not exactly moving forward into the next phase. Is that the right tactic at this point, do you think?
I think it is the right tactic. I mean, what we've said from the very beginning is that really states need three things in place. They need testing to the point that the positive tests coming back is below 5%. They need contact tracing in place so that you can actually identify everyone who's been in contact with someone who tests positive. And then you need a population that's actually willing to take mitigation measures when we see improvement, when we see problems arise. And what we're seeing is, at least on the contact tracing and on the population, a lot of states are failing. And that's why we're seeing the uptick in California, in Florida, in Texas, in Utah, in Alabama, in Arkansas, in Arizona, really across the country, is because we're failing in those ways. So yes, it makes sense to pause until you can get your hands around the current crisis.
Chris, what's the probability that because of the rising infections that we're seeing, we will see more deaths over the next week or two? I think a lot of investors are not thinking about that outcome.
Yeah, initially people were saying, well, there's an uptick in cases, but we aren't seeing more hospitalizations. Then naturally, after a certain number of days, hospitalizations go up. Well, what we know, after hospitalizations go up, after a period of time, deaths usually follow. The one positive sign, or maybe two positive signs, is one, the people getting infected are younger, which means they're less likely to die from this. And two is that we actually have much better treatment protocols. So while we may not have a drug that cures it, we understand better when to put people on ventilators, when to use high-dose oxygen, when to do all these other treatments to help address it, which should make the death rate lower than what we saw at the peak in New York, New Jersey, and Connecticut.
You know, Chris, as far as the stock market is concerned, by and large, investors have been ignoring the rise we've been seeing in these COVID-19 cases until I'd say the past couple of days. Is it time for them to be paying a little more attention? And has the market, in your view, gotten ahead of itself given all of the headlines about COVID?
I see a lot of volatility from COVID and the election going forward. So my colleague Ed Mills, I think, joined you the other day talking about the likelihood of a Democrat sweep being higher than the market anticipates. When we look at COVID, while we don't think a nationwide or statewide shutdown is likely to occur, we do think you could see some localized activities, right? There are three options, and we put this out yesterday to our clients, that really we could see going forward. One is you can pause reopenings, which is what Texas and Florida has done, though largely speaking, they were reopened already. You could see entities reverse course and go back a phase, which we haven't seen really yet. Or you could see completely new mitigation measures. I think what we're likely to see is a pause and very targeted areas of restrictions when needed. Like yesterday, the governor of Texas said, no new elective surgeries, but he limited it with a huge caveat saying, well, only in areas where if you do elective surgeries, you can't care for enough COVID patients. If you can do electives and have COVID patients, you're fine, continue on. I think we're going to see more of those types of approaches.
Chris, set the scene for us on this one. The Trump administration overnight filed a brief urging the Supreme Court to invalidate the Affordable Care Act. If for some reason the Affordable Care Act is in fact overturned, what type of chaos would that cause from an economic standpoint as the country is dealing with a pandemic?
Yeah, the bottom line is if they overturn it and they overturn it in a way to say the next day, basically it's over. I think if they did overturn it, they would give a runway for new activities. But the reality is dramatically more people would be uninsured unless Congress takes action to pass something new to replace it. Republicans are assuming that if the Affordable Care Act is struck down by the Supreme Court, that will bring Republicans and Democrats together because no one wants to see 20 million plus more people uninsured. I think that is an ambitious goal. We saw that really both parties are not working together on healthcare. And when you look at the election results, if you do see a Democrat sweep, we could see healthcare reform 2.0, which could go even further than the Affordable Care Act went, like on a public option, which Joe Biden mentioned in his speech yesterday.
So, which presidential candidate does the pharma industry want to see in the White House for the next 4 years, Chris?
I don't speak on behalf of the pharmaceutical industry, but I suspect they would probably rather have a Trump in the White House because at least up to this point, he has been all bark, no bite on drug pricing. He said a lot of things, but he actually hasn't done much. You've seen prices come down really because of the approvals on the generic side and FDA approvals. But when it came to the rebate rule, when it came to international pricing index, importation still hasn't made a tangible impact. So, there's been a lot of noise. There hasn't been a lot of substance. I think if Biden gets in the White House and you see a Democrat sweep, pharma is going to be targeted and they're going to have to give up something probably.
All right, we're going to leave it there. Chris Meekins, healthcare policy analyst at Raymond James. Good to see you. Enjoy your weekend.
You too.
Coming up, we're going to break down the stock market as we are about 8 minutes away from the opening bell on this Friday morning. Kanye West partnering with The Gap. We're going to talk about that partnership right after this. We are looking for a lower open on Wall Street this Friday morning. Jared Blicker, you've been looking at the charts all morning long. Looks like financials are leading us lower following those Fed stress tests yesterday.
Yeah, that's right, Alexis. And the big banks, some of them under a little bit of pressure here. We'll go to that in a second, but a lot of green around the world, as you can see on the Wi-Fi interactive world index map, except for the United States here. So we got the Dow down about 0.6%, S&P down 0.3%, and the NASDAQ just off about 16 basis points. And looking at our NASDAQ 100 heat map, we can see lots of green from yesterday. But if we look at, for instance, Facebook, they are down about 1.22% in the extended hours trading this morning. Amazon's up about 0.2%. And just taking a look at those bank stocks, Goldman Sachs is down about 3% right now. Some of the better fares are Citigroup, they're down only 0.3%, and Morgan Stanley is up about 18 basis points. Wells Fargo also said to be having to potentially scale back its dividend. They're down 4%, and we'll find that out 4:30 p.m. on Monday.
All right. I know you'll be there for us. Thank you, Jared. All right. So one stock bucking this downward trend today, Gap, looks like they have Kanye West to thank for their big rally this morning. What's going on there?
Yeah, it looks like Gap and Kanye have signed a multi-year deal for the Yeezy line. And so you're going to be able to get Yeezy Gap hoodies and t-shirts in 2021. And that stock is up 20% in the pre-market here. Just taking a look at its performance this year, though, we can see it's been under a substantial amount of pressure, still down about 42%. Also want to draw our attention to Vaxart because this stock has been fast-tracked by the president as part of the COVID-19 response for potentially looking for a vaccine. Now you can see this stock is up 1,700% year to date. Just this week alone, it is up 146%.
All right, thanks for that, Jared. And stay with us. When we come back, we'll take a look at the opening bell on Wall Street and talk more markets after this. Breaking news from Microsoft right now. Microsoft is going to close all of its physical store locations. It is part of the software and cloud giant's new approach to retail. Here we have the opening bell on Wall Street. And we have a new trading day underway on this Friday morning. We saw Dow futures under pressure. This is resulting in the Dow off 180 points here right out of the gate. Taking a look at the headlines, making the first trade front page, another 40,000 new cases of COVID-19 in the United States have been accounted for overnight. That is a new record over a 24-hour period after a number of southern and western states see a resurgence. And many states, including Texas and Florida, are now pushing back their next phase of reopening. This as the White House's coronavirus task force is expected to hold a public meeting today for the first time in 2 months. And despite being in the middle of a global pandemic, the White House is asking the Supreme Court to invalidate the Affordable Care Act. The administration argues that it's illegal since Congress eliminated the tax penalty for failing to buy medical insurance. Now, it's unclear if the justices are going to tackle this issue before the November election. More than 11 million people signed up for the Affordable Care Act this year alone. And lawmakers are looking to upgrade Washington, D.C. The House is expected to pass a bill that would give D.C. statehood status. But don't expect to go out and get an updated American flag anytime soon because Senator Mitch McConnell already said he won't even bring the bill to the Senate floor for a vote. That's because D.C. would make it more difficult for Republicans to win a majority of seats in the Senate, since D.C. voters usually vote for Democratic mayors. All right, let's take a look now, a closer look at the markets with Jeffrey Kleintop. He is the Chief Global Investment Strategist over at Schwab. Good to see you, Jeffrey. Always nice to have you on the program. What do you make of the market behavior this week as we see the number of COVID-19 cases continuing to surge in pockets of the country? Where are our investors' heads at the moment?
Well, obviously, it's a balance between the economic recovery that's in place, and certainly the data we've been getting has been very solid, combined with concerns about fears about what lies ahead and the rising number of cases. Fortunately, we haven't seen as much of an uptick in new deaths. What I've noticed is that the stock market seems to be tracking the deaths more than the case data, and those continue to remain fairly contained, although maybe ticked up a little bit in recent days, still way down from their peak back in April, unlike cases, which have surged since then. So that's an encouraging sign, and one that's echoed around the world.
Jeff, give me some positive catalysts for the market as we look towards July. I don't see many on the horizon. To me, a lot of those positives have been baked in May and June, but what do you see?
Yeah, I got to agree with you there. I think some of the positives could be maybe tied to a shift in how the bond market is perceiving some of this data. You know, we've seen a big move in the stock market, but the 10-year yield is what, 65, 66 basis points? I mean, still pinned to the lows. I know there's some thoughts that the Fed might engage in some, yield curve shaping, but it seems low relative to what the stock market is pricing in terms of a recovery. We don't think the yields stay there. We think they're higher as we head towards year end. And so that could mean some momentum to sectors that actually benefit from higher yields, like the financial sector, which is a laggard today.
What do you make of the pullback we're seeing in financials given the results of those stress tests? I mean, yes, the Fed did cap the dividends. They didn't take away the dividends. They're capping the buybacks. They didn't take away the buybacks. And by and large, the banks, came out swimmingly following those stress tests. So why this pullback that we're seeing today, you think?
Short term, I think we know buybacks have been a powerful force lifting stocks in recent years. So knowing that they're out of the equation for a while, is a bit of a blow, perhaps to near-term momentum to the market. But we actually like financials. It's a sector we recently upgraded in the last week or so to an overweight. Obviously, the weakest sector today, but it's not been that bad this week. I think as bond yields rise later this year, maybe a steeper yield curve will help. And it's one of those sectors that's sort of interesting. It's kind of an in-between as it relates to economic growth. It's not a sector that thrives on a V-shaped economic recovery like the energy or materials sectors that have been great performers off the lows. Likewise, it's not going to do well if we head back to recession. That's utilities. It's one of those in-between sectors where more modest economic growth, as we see this V-shaped recovery maybe flatten out a little bit, could do fairly well in that environment. That's an environment that we see as most likely here in the second half of the year.
Jared, over to you. Hit us with some charts today.
I'm sorry?
There we go. No, I had to unmute myself.
It's Friday. It's all good, man. All good.
I was just looking at the energy sector based on Jeff's comments, and we're seeing some red right now. Crude oil is going to end down for the week, but it could have been worse. In fact, crude oil's had such a nice run. It's only been down 2 of the last, I believe, 9 weeks. Let's take a look at our NASDAQ 100 heat map. FANG names, kind of a mixed bag, although we do see most of them under pressure. Amazon bucking the trend, up about 0.8%. Facebook down 2.4%. And just sorting by performance, we see the big leaders are NetApp, that is up 3.5%, followed by eBay, and then Broadcom, Dollar Tree, NetEase. Kind of an interesting mix here. To the downside, we talked about Facebook, that's the biggest loser. And then some travel names. United is down 1.6%. And just looking at our travel heat map, cruise lines, well, most of them in the red right now, but Carnival bucking the trend, they are up about 0.25%. And looking at the Dow, we see weakness in the financials, which we've been talking about. Goldman now off about 5%. Industrials also weak. Boeing's off about 2%. And then some of the winners, Home Depot's up 0.25%, along with Intel and Procter & Gamble. That safety staples play is up about 0.25%, Brian.
All right, Jared, I'll take it. Thank you. Jeffrey, we were talking a moment ago about catalysts for this market this summer. One I'm thinking about is trade, right? I mean, the U.S.-China trade situation is sort of percolating in the background as we continue to deal with surging cases of the virus. But how much are you considering that when you look at portfolios, and is it dictating how you see the market?
Trade is a big concern. Obviously, it can move the markets pretty significantly on any day. And if we were to see an eruption in that trade tension, meaning that the phase one trade deal would be gotten rid of, disposed of, that would be a grave concern. That doesn't appear to be the case. President Trump appears to be addressing and challenging China in other ways and leaving that trade deal on the table. So I feel like that's probably relatively intact. The U.S. versus the EU is a concern. Of course, as we look at the post-Brexit environment, the UK trying to work out a trade deal with the EU, those issues still linger. And you're right, could come up this summer as a potential hiccup for the markets.
Jeff, when you talk to clients right now, what's their number one concern?
It's really the virus. I mean, it's really about a second wave. And that's why I'm encouraging them to focus more on the deaths than the case count. We've seen the case count rise in a number of countries like Sweden. Sweden is certainly in a second wave of new cases, but the deaths in Sweden continue to steadily decline. I think that's what the market's going to be keying off of. But absolutely, that's their number one concern at the moment.
And what about these pandemic trades that we've all been talking about, the airlines? Actually, American Airlines today, a short while ago, coming out and saying it's going to stop capping seating capacity on planes beginning July 1. What do you see as the trade there for those stocks?
Well, it depends so much on local activity. It's interesting to see. Maybe you could look at box office results or dining reservations as an example of how willing people are to be with each other in an enclosed space for an extended period of time. Now, we've seen dining reservations tick up in Australia, Germany, places that have really nailed COVID down. Other places, not so much. Dining reservations still remain fairly low. And box office results, they're doing pretty well in Asia, but nowhere in Europe and certainly not in the US. Most theaters aren't even back open again in the US. So I think that's going to be very localized. Maybe some Asian airline travel, they could loosen some of those restrictions, but I'd be surprised if in the US that proves to be successful.
All right, Jeffrey Kleintop over at Schwab. Always good to see you. Thanks so much.
For having me.
And we'll be right back. The coronavirus is even taking a toll on Nike, the retail giant posting an unexpected quarterly loss and sales decline in its Q4 earnings report. Yahoo Finance's Emily McCormick has been sifting through this one. So even though Nike didn't have a great quarter, still doing a lot better than the competition, right, Emily?
That's right, Alexis. If we take a look at Nike stock for the year to date, still outperforming the competition, although it is one of the laggards in the Dow today. That stock is off about 3.5% just after market open now. And taking a look at those fiscal fourth quarter results, pretty disappointing relative to what the street had been expecting. We saw sales drop 38% over last year to $6.3 billion. It was well below expectations for $7.4 billion. And as you mentioned, we did see a surprise quarterly loss with an adjusted loss per share of 5 cents versus earnings per share of 10 cents anticipated. We also saw a big hit to gross margins, with those down 8.2 percentage points to 37.3%, mostly due to order cancellation costs along with supply chain disruptions due to the virus. But the biggest hit that we saw during the fiscal fourth quarter was because of Nike's wide array of store closures because of the pandemic. So we saw 90% of Nike's physical stores across all its regions outside of China and South Korea closed for about 8 weeks during the quarter. Now, Nike did offset some of these brick and mortar sales declines with a rise in e-commerce, with digital sales up 75%, but clearly that wasn't enough to completely make up for the decline elsewhere. Now, looking ahead, we have Nike now with about 90% of its stores open across the globe, including all of its stores in Greater China. The company said retail traffic continues to improve week over week with higher conversion rates compared to last year. Brian and Alexis?
All right, thanks very much, Emily. Appreciate that. Coming up next, we'll speak with Ford COO as they take the wraps off their brand new F-150 pickup truck. We'll talk about it right after this. Ford took the wraps off its new F-150 pickup truck last night. It is all the buzz in the car industry this morning. And we had the chance to speak with Ford COO Jim Farley a short time ago about just what this truck means for the automotive giant as it looks to make a comeback.
It's fundamental. The F-Series lineup is the second most valuable consumer product, only second to the iPhone. So from a revenue and profit standpoint, it is fundamental to the company. And we poured poured our heart and soul into this product. We're number one for over 40 years in the US as the most popular vehicle. So it's not only important for Ford, it's important for the US.
Jim, it's a beautiful truck. It looks like you're trying to appeal to an even wider audience with this F-150. How do you balance keeping traditional truck buyers happy, but also staying on the cutting edge when you have a lot of other car companies nipping at your heels, right? You've got Tesla, Bollinger, Rivian. We actually spoke to the CEO of Nikola recently, who actually said, we are coming after the F-150. How do you remain the leader in that space?
Well, you have to invest. And look, we sell almost 1 million units a year. So we know our customers really, really well. And you have to invest. You have to think ahead. We put an onboard generator, something that no one's ever done before, 7 kilowatts. You can power a whole job site. Our testing is like no other truck. No one has experience that we do on Bill Ford Tough. We have the most towing payload. But you have to put the new technology like over-the-air updates, and you have to have the productivity, especially for the work buyer. So for us, it's all about looking around the corner, putting the technology in the truck, but also having that foundation of proven durability, proven credibility in terms of getting jobs done.
Jim, who is the target customer for this? Sure, there's Joe the farmer and Joe the home builder, but when you look inside the truck, you have seats that now fold, that could fold nearly flat. You have a workstation to fit a 15-inch laptop. It seems to be this is a truck in many respects. It's a rolling office.
It really is. But, you know, we've been doing a lot of research in the last couple of years, and we found that customers now are spending almost as much time in their products not driving as driving. It was a really shocking statistic to us. More and more people are using their vehicle as a safe space outside of their home. We see it around the world, but even in the US. The target customer is super broad. I mean, we have Raptor customers who pay almost $100,000 for their F-150. We have an XL, work truck in a mine in Montana that paid, $30,000 for a basic truck. So it's everyone. It's a very broad, because we sell almost 1 million units. So it is the #1 selling vehicle in the US. So it's a huge, very broad customer base.
Hey, Jim, what's your favorite feature on the new F-150?
I think it's got to be the onboard generator. I mean, when you go to job sites like our engineers do, we just see every job site has a noisy, stinky generator. And they're expensive. Some of them are up to $10,000. And to have a truck make no noise, power the entire job site with its hybrid powertrain, to me, it's a symbol of using electricity and battery electric power to do jobs, not just to be efficient.
Jim, it's turning out to be a pretty important summer for Ford. Right after the F-150, you have the Bronco being revealed in July. When you look at the Bronco, will that be a mass market vehicle, or do you think it'll be, or you focus on more of the niche consumer there?
So we do have a big summer and fall, because not only we have the Broncos actually, but we also have the Mach-E coming, our first ground up battery electric vehicle based on a Mustang. So it is very important for us. Bronco is going to be a mass product. But it's really designed for people who want to get out there in the wild. It's a really capable off-road vehicle, something that a lot of Americans have been asking for from Ford. We're the #1 cross-shop vehicle with Jeep, and now we're going to bring out a lineup of products to give those customers an alternative.
Jim, this pandemic has upended auto sales. It's changed the way we buy cars. People are looking for more personalized service. They're looking online to buy cars. Has the virus essentially changed the way we shop for cars forevermore?
I think so. I think it really has. About 1/3 of our sales are online now, but a huge percentage of our service and delivery is now being done remotely, where customers live, where they work. I don't think we're going back. It works better. And I would say from a working standpoint, so many of our knowledge workers have become a lot more productive working at home. So it changes our real estate footprint as a company. We're going to have to develop different kinds of interiors. Absolutely, it has changed our industry, and I don't see us going back.
Jim, has demand for you bottomed in the U.S.? And then secondarily, when does it all come together for Ford? You're a Ford veteran. I'm no surprise that the business it's still in restructuring mode. When do you get the sales coming back, the profit margin benefits from the cost cutting? When does that all come together for the company?
It's a great question. I would say, the fourth quarter of this year, third and fourth quarter in North America is when we start to see the real goodness of our cost and restructuring efforts, when we start to see the benefits of these new products. It's really going to be 2021 for a full year. But towards the end of this year, you're going to start to see what Ford can do in terms of profitability. It's when our costs flow. It's when we launch these brand new products, we start to grow. As far as when Ford started to see a turnaround, it really is kind of the end of this quarter. June has been a real turnaround month for us because sales are now accelerating towards a pre-COVID level, although lower. But for us, 30% of our sales are government, fleet, large commercial sales. We're the commercial leader in the US and Western Europe. And that fleet sales really didn't come back until this month. Those fleet sales are very important for Ford. Large companies like U-Haul, they're very important for us and our profitability. And we started to see that market come back this month.
Alexis, very important what Ford COO Jim Farley just told Yahoo Finance. June, there has been signs of a turnaround. And for a company that has been in a perpetual restructuring the past year and a half, 2 years under CEO Jim Hackett, maybe signs of a turnaround finally starting to emerge. But I think the market wants to see it. They want to see a good quarter from this company.
And this getting it right with the F-150, which is America's top selling vehicle, is so critical for this company. I mean, he said it at the top of the interview. It's fundamental because during the pandemic, Ford has had to shut down production like other automakers, but Ford actually took on $20 billion in debt. So not only does it have an $11 billion restructuring plan it needs to pay off, but it also has $20 billion in debt. It's looking to the F-150 to help with that. It's looking to that new Bronco to help with that. So a lot riding on this launch for sure.
And it's also the truck too, Alexis, but also the Bronco that will come in July, the Mach-E. And then by 2022, Ford is still expected to have an electric F-150 out, which is very important. I'm sure our producer, Nick Monti, has his eye on that one too, after he buys the one that's about to hit the market this fall.
Yeah, I hope you're saving up, Nick, because the starting price for the Ford, like basic, this new F-150 is about $30,000. But if you go upwards and put in all the bells and whistles, you could be spending more than $70,000 easily on this new F-150 pickup. So it's not just a utility; it is a luxury ride, right? I mean, that cabin is luxury.
Alexis, mere pennies for our very own Nick Monti. And you know what? He deserves that giant workspace in the middle center console for his big laptop.
Yeah, I like it. All right, Nick, we're all going to, I don't know, start like a GoFundMe page or something for your new F-150. Maybe you could do the show from your truck. I mean, anyway, Jim told us a lot more people are actually just sitting in the truck, not necessarily driving it. They're like living in it. All right, let's get another check of the markets now with Jared. What can you tell us?
Well, we're sitting on some losses right now for today and for the week, except for the NASDAQ and the NASDAQ 100. I was just looking at the NASDAQ 100 heat map, though. Today, Amazon has stand out up about 1/3%. But look at Facebook. Facebook down about 3, almost 4% right now. Just looking at the performance leaders, we got NetApp followed by Ross, Dollar Tree, eBay, O'Reilly Motor. So some of those retail names doing well today. To the downside, United, along with some other travel names, having a bit of trouble here. Facebook, we already mentioned, then T-Mobile and BioMarin. Those are down over 2%. Looking at the Dow, we're going to see some financials under pressure. JP Morgan's off about 3.5%. Goldman Sachs now down over 5%. The standouts tend to be the staples play like Procter & Gamble and Walmart, Home Depot, just barely in the green right here. So financials and energy are leading to the downside, and we can see the travel stocks here that we were talking about before. Only Carnival and Travelzoo are in the green right now. United is down about 4%. Let's take a look at some of our commodities because crude oil is ending down for the week, but not by much. It's still at $38 per barrel, under that $40 a barrel that we've been tracking. And just looking at a longer term price chart here, let's look at year to date. You can see we have this nice uptrend still intact, filled this gap at about 42. And we do have a trading range of about $35 to $41, $42 here that we are still in. And then taking a look at gold, gold has had a decent run recently, but it is backing off of its highs. And we can see this right here. That is actually very close, at least on a closing basis, to a multi-year high. You'd have to go back to 2012 to see that. And then copper. Copper's only down 4 basis points, but it has been having a spectacular run. Look at that off of the lows right here. Now down only 5% year to date. And in one other exchange, not this one, it passed $6,000 per ton for the first time since earlier in the year. Now let's take a look at some individual stocks here. And we're going to take a look principally at Gap, and also we're going to take a look, if I can find it here, there, Luckin Coffee, down 50%. They're going to be delisted on June 29th. They withdrew their plea for an appeal, and so they are down 54%. And then Gap joining with, Yeezy, that is up 37%. Alexis.
Yeah, Conway getting in on the action at Gap. All right, did you ever want to pick Jared's brain about the stock market, everybody? Well, now you can, because Jared Blickery is going to host Trading Stocks and Managing Risks in the COVID-19 Era. It is a special webinar for Yahoo Finance Premium subscribers, and it's happening Wednesday, July 1st at 2 p.m. Eastern. Looking forward to that. We'll be back after this.
All right, welcome back to the first trade. You're seeing the markets under a bit of pressure on this Friday morning, but if you're looking for a feel-good story for today, Kanye West is teaming up with Gap, sending Gap shares way higher on a new capsule collection, multi-year deal. Potentially, maybe Kanye will save Gap just like he saved Adidas, and that would be a feel-good story. Let's get right to Inez Ferre, though, who is watching several stocks, including Nike, after its earnings report last night. Inez?
That's right, Brian. And Nike under pressure, down about 4% after swinging to a quarterly loss. The company saw a sales decline for its latest quarter. Its results were affected by store closures throughout much of the quarter. Also taking a look at Big Lots, that stock is up more than 22% after the company gave an update estimate for its second quarter, expecting to exceed previous expectations, lifting its adjusted earnings range, and also predicting that its gross margin rate will come in higher than the same quarter last year. And as you mentioned, Gap up more than 41% after announcing that deal with Kanye West and his fashion company Yeezy to create Yeezy Gap, which will be introduced in the second half of 2021. I do want to mention H&M earnings, a rough quarter for H&M with its net sales declining 50%. The pandemic has definitely accelerated its shift into digital. The company plans to close some stores and also not open some planned stores that were going to be open, really accelerating that shift into e-commerce. Brian?
Yeah, and I was excited about that Kanye collection. Maybe I'll go back to Gap for the first time in 20 years. Pretty pumped. We'll check back with you later. Thanks. Let's get back on the markets here and bring in Dennis DeBoucher, Senior Managing Director at Evercore ISI. Dennis, always good to speak with you. I follow your work very closely every single day, and I know you're very plugged into market sentiment. Are you sensing any near-term change in the markets? This week hasn't exactly been good.
No, I mean, the market has clearly swung to a fairly bearish backdrop. You can see this in a lot of the survey data we look at where hedge fund net exposure is still net short relative to benchmark. We've seen skew increase meaningfully, which is the easiest way to explain that is catastrophe hedging has gone back up to historical extremes. And so people are preparing for the potential of a really bad outcome as it relates to new case growth, which we think actually creates some opportunities potentially, but that's what people are worried about right now. And it makes sense given, Texas governor announcing some rollbacks and natural, if you will, social distancing that can lead to weaker economic growth. But fatalities is the most important thing to focus on here. And to the extent that fatalities do not go up significantly, the next 2 weeks, by the way, are critical. You can see a lot of unwinding of those hedges, and that does create some opportunities.
That's really interesting. You're our second market expert today to call out the rate of death being something that investors are really honing in on. You said a moment ago that this could create some opportunity, as people sort of pull back. Where do you see that opportunity?
Yeah, it's a good question. So the most opportunity we see right now, which is where most people in my position go to die, unfortunately, is in value. Right now, value, at least from a price earnings multiple, is at the most extreme it's ever been relative to growth. And that's the market pricing in a very weak economic outcome. So like I said, this is where I'll go to lose my career. But in any event, it's, the math is the math. You get any type of re-rating in stocks relative to credit, then a lot of the sectors that make up value, particularly something like financials, which obviously that's some bad news overnight, will rebound significantly. Of course, that assumes that you don't see a sharp increase in fatalities. And if you don't, that's the type of re-rating that can happen very quickly, especially as the quantitative investors kick in very quickly and reprice to that information almost instantaneously.
Dennis, can you quantify what would be, in your mind, a sharp increase in fatalities? What would the market need to see? And then what is a re-rating? Is that a correction, about 10% or perhaps more?
So a re-rating, I'll start with that one first. So on a re-rating, I would look at the specific sectors. So on the market, I would say anywhere from 7 to 10% higher, right? And then on a sector basis, if you look at something like financials, as for instance, their implied cash yields relative to comparative credit imply 50% upside if they just normalize. Now, I'm not trying to make a call, by the way, that they're going to go 50%, but just making a point that there's this odd anomaly taking place. And so you could see much bigger moves than anybody's pricing in right now. On deaths, you don't want to see an increase in the 7-day moving average to start looking like what we're seeing at hospitalization rates now. So if you look at it on a chart as an example, you see new case growth going up significantly, which we know. We've seen the turn in net hospitalizations, which happened over the last 3 days. And so if you start to see the trend in new deaths follow what's going on in net hospitalizations, which would be an increase from about 700 a day to probably 1,000 on a 7-day rolling basis, that would be worrisome.
Dennis, you mentioned a moment ago that investors are doing what you're calling catastrophe hedging?
Mhm.
If they are, what are they hedging with? Because the market is lower, but I'm also seeing commodities mostly lower, gold down more than 0.5%. So where are people hedging right now?
So it's basically way out of the money options on the S&P. So that's where most of the hedging is taking place. I would say the other one is clearly in long duration assets. So that's why you see 10-year yields pinned at very low levels. So despite the fact that it appears that we're going to have another fiscal program that's going to be 8% of GDP likely on top of the 10% we already have, and then potentially something again after the election, rates aren't moving at all. So clearly there's some hedging going on in long duration assets. So you're buying long duration assets. You're buying way downside protection on the S&P through the options market, and gold has held up relatively well. We hear some hedging in there, and then just owning growth names relative to everything else.
Dennis, we're seeing, we just got some breaking news that Texas is rolling back its reopening day after pausing plans because of its cases continue to be on the rise. What are the chances that the market switches from focusing on fatalities related to COVID and just started simply trading off on fears that the country may close down again?
Yeah, I mean, I think fatalities is what drives a more widespread closing. So there's a difference between rolling back some opening and phasing and going to stay-at-home orders. That's a large difference. I think fatalities would drive a move to stay at home, and that drives the S&P from roughly 3,000 down to somewhere 2,700 or below. I think if you have, let's call it minor shutdowns or just rolling back of the phases for a short period of time to see if social distancing starts to take its effect over a 2 to 4 week period, if masks are starting to be worn and they start to work, and people think that that's a possibility, you're probably not going to see too much of a reaction. In my view, it's not a positive, by the way. It doesn't mean the market's going higher on this news. It just says, I don't want to get too excited about shorting the market or being negative on the market if we're having just isolated kind of rollback of phases, which might not change in aggregate spending too dramatically.
Guys, I just want to add to what we were talking about with Texas. So Governor Abbott ordering Texas bars to close again, restaurants to reduce to 50% occupancy as the virus continues to spread there, and hospitals in the state of Texas begin to be stretched. So Dennis, how important is another stimulus package? And if we don't get one, what happens to the market?
All right, so I'll start with the second one there first. That's an easy one to answer. If we don't get another stimulus package, the market's going down. Simple as that. We have a sharp fiscal cliff coming on July 31st when unemployment insurance benefits roll off. You already seen a significant decline in fiscal impulse relative to the first fiscal package, checks being spent, PPP being taken up, et cetera. So market goes down, full stop. And there's not really much more interesting to add on that. So to answer your first question, the odds of a fiscal stimulus go up. It seems, and the size of the package potentially. So we're estimating at Evercore ISI of a 1 to 1.5 trillion stimulus. There's potentially upside to that if, in fact, we have a worse reopening, which looks like it's the case right now. So that's a potential good news down the line for the market. I understand how it's bad news today, but listen, if you look, let's pretend we're here and I'm talking to you in August, and it ends up that we have a 2 trillion stimulus and social distancing measures appear to be working, we could be talking about a whole different ballgame as far as the market's concerned.
All right, so you say if no stimulus, market drops, period, end of story, but by how much? I mean, are we talking a 10%, a 20% correction?
Oh, good question. Yeah, I think you're looking at a minimum 10 to 15% range, minimum. And then from there, it's going to be about your expectation for the policy response. So you probably go down 10 to 15%, and then we'll all wait around to see if that 10 to 15% causes the political apparatus to get moving quickly. And if you ultimately get nothing, by the way, then it's a 20% down, and we'll reassess from there.
All right, let's leave it there for now. Dennis DeBuscher, Senior Managing Director at Evercore ISI. Always good to talk with you. Have a great weekend.
You too. Thank you.
All right, just stick around. Much more ahead on the markets on the first trade. Welcome back to the first trade. Today we're taking a look at Delta Airlines shares on yahoofinance.com and our trusty web app or mobile app. It's resuming its service to China after nearly a 5-month break due to the coronavirus pandemic. Yahoo Finance's Inez Ferre is back with the details. Inez?
And Brian, Delta this morning is down about 3%, but travel stocks in general this morning, all of those are down. And Delta is resuming its flights to China, starting with Seattle this week. The Seattle-Shanghai route started. Also in July, the Detroit to Shanghai route will start. And Delta says that it'll start using electrostatic spraying of the cabin before every flight. The main cabin will have a capacity of 60%, and the middle seats will remain open. Yay for the travelers. And of course, the airlines have announced that they are requiring people to wear masks. So this is one of the requirements that Delta and other airlines have also announced.
And Inez, the major airlines have a pretty important meeting today, huh?
That's right. Well, the unions for the airlines have asked Congress, they want more money from Congress to secure their jobs through March of 2021. Remember that with the CARES Act, the airlines received money in order to keep their employees through the end of September. But then you had airlines like American Airlines saying that it would need to lay off workers. They're asking workers to volunteer, basically, to be laid off to take packages after that September 30th date. So basically, the unions wanting to protect their employees' jobs through March 21st, because of course, people are still reluctant to get on planes.
Yeah, that's for sure. Inez Ferre, thanks so much. Alexis?
All right, thanks, Brian. A group of Democratic activists are reportedly looking to use President Trump's Twitter habit against him. CNBC says tech investor Xander Schultz is launching a new super PAC called Defeat by Tweet, and he's lined up $1 million pledge from former hedge fund executive Mike Novogratz. Senior columnist Rick Newman is here for this one. So this is a novel idea, Rick. From what we understand, this PAC is going to pull contributions from donors every single time the president tweets, regardless of what it is he says. And given how he tweets, I'd have to think they're going to be able to raise a lot of money here. What do you think?
Right. It's already set up. I'm looking at the site, so anybody can go see it. It is defeatbytweet.org. So the idea is you can pledge anywhere from 1 penny to $1 for every tweet Trump puts out there. And this group says he tweets 900 times per month. So they're capping your maximum donation at $9. So obviously what they're going for here is they're trying to get tons of people involved, small donor pledging basically. And then every time Trump makes a tweet, the plan is they're going to tweet back at him and say, you just helped us raise $3,000 or $5,000 or however much money they raised. And this super PAC is going to contribute the money to racial justice groups in swing states. So I presume those will be groups that are trying to defeat Trump and get his opponent, Joe Biden, elected. So novel approach here.
Rick, if more of these pop up, could this be a difference maker in the election?
I don't know. I mean, the idea that you have to have the most money, that the candidate with the most money wins, is really not true. Hillary Clinton had more money than Trump did in 2016. She obviously lost. It's a question of how well you use the money you have, how effectively you organize. And this is going to come down to just an incredible amount of activity in about 6 or 8 or maybe even 10 swing states. Those are the states that are that will decide who wins the election. So that's Florida, North Carolina, Pennsylvania, Michigan, Wisconsin, Arizona. Those are the 6 core swing states. So I guess there's just going to be a ton of activity there. There does come a point where if all you're doing is running ads, people, the networks are just wall to wall filled with ads by election day. And that probably has a diminishing return. But there are other things you can do that are effective as well. Register people to vote, raise enthusiasm, make sure people know how to get absentee ballots, help them get absentee ballots, mail ballots, whatever, all that kind of stuff.
Yeah, Rick, you bring up a great point. I mean, look at former New York City Mayor Mike Bloomberg. Had a lot of money to spend. He threw a lot of money at his presidential campaign and couldn't even secure himself in the primary. He had to drop out. So
he did win a couple delegates from American Samoa. Give him that.
You're right. You got to give him his due. But What is going to move this election? I mean, you ticked off a few of those things, but what could really make a difference here?
I think we're already seeing it. It is the coronavirus pandemic, without a doubt. People don't blame Trump for the virus. They shouldn't. The virus is not his fault. But the halting federal response to the virus is his fault. His refusal to mount any kind of federal effort to do testing, which obviously we need. I mean, look what you guys have been talking about happening in Texas and Arizona, where it's getting worse, not better. We're having more business lockdowns rather than fewer. So that and the economic recovery, Trump is in a deep hole. There was a poll this week from the New York Times that finds him 14 points behind Joe Biden nationally. And Joe Biden has barely been doing anything. So Trump is in a huge hole. It doesn't mean he's going to lose, but he's got a ton of work to do to counter all this stuff we're talking about, including defeatbytweet.org.
Yep. Biden is coming out of the basement, though, a little more these days. So we'll see
he's sort of slowly getting out on the campaign trail, giving, speeches to tiny groups and doing a few more interviews. He probably thinks that maybe he doesn't need to do a lot more than that. I mean, why mess with it if you're rising in the polls?
Yep. And he may not. Time will tell. All right, Rick Newman, thanks a lot. Always good to talk politics with you, my podcast buddy. Have a good weekend.
Yeah.
All right, thanks, Alexis. And do stick around. On the other side of the break, our very own Julia Roche sat down with Salesforce founder Mark Benioff. Welcome back to the first trade. The hashtag Stop the Hate for Profit campaign continues to gain steam. The latest big names to join include advertising agency Goodby Silverstein, owned by the Omnicom Group, and our very own parent company, Verizon. 1 week ago, 6 organizations called on Facebook advertisers to stop spending money on the social media platform until it can provide a safer place to express points of view. Goodby Silverstein, whose clients include BMW, HP, PayPal, and PepsiCo, joins Unilever's Ben & Jerry's, The North Face, Patagonia, and Upwork. Joining us now is Yahoo Finance's Julia Roche. Julia, you had a very interesting conversation with Salesforce founder Mark Benioff about this. What did he tell you?
Hey, Brian, that's right. I got to talk to Mark Benioff in a wide-ranging conversation. And keep in mind, he has been at the forefront around the critique of Facebook. This goes back to the World Economic Forum in 2018 when he compared the social network to cigarettes. So I brought up the campaign with him and I got his latest take on Facebook. So take a listen.
Facebook is the new cigarettes. It's addictive. It's not good for you. They're after your kids. They have a product called Facebook for Kids. They say publicly that their highest values are not truth and trust. that they don't really care what the quality is of their content on their platform. That's amazing to me. And, you know, if your company values are not about truth, that the highest value and most important thing to you in the business world is not about trust, I don't have a lot of time for that. That's amazing. So this is a moment in time where all of us have to ask that question for our companies. Number one, what are our most important values? What are the values? What are the bedrock that we're building our companies on? And yes, different companies, just like different individuals, have different values. We can all ask ourselves, what's the most important thing to us? But when we look at a company like Facebook or other social media where we're getting news and information, and it might not be accurate, or we might be being misled, or there might be misinformation. Well, Julia, we've got to come back to truth and trust. You know, I also own Time Magazine, and I can tell you that every week we work our hardest to make sure that that's about truth and trust. That's the core values of Time Magazine for 95 years. That's why when people get that magazine in their home, which has been so important to so many families during this time, that they can rely on this information, how to succeed and be healthy during the pandemic. Well, you've got to give people the true information. Otherwise, you're going to end up with more sick people. Who wants that?
Yeah, guys, interesting take, especially since Benioff, as he was just mentioning, is the owner of Time Magazine, and talking about company values, that those highest values must be truth and trust. And here you're seeing this movement of nearly 100 companies now have signed up to pause their advertising while the Stop Hate for Profit campaign pushes for changes from the social network. So you have to imagine a number of these companies are also asking, not only looking internally at their values, but asking Facebook really to look at their own values. Brian?
Yeah, Julia, I did want to read this statement we got from Facebook to Yahoo Finance. Quote, "We respect any brand's decision and remain focused on the important work of removing hate speech and providing critical voting information. Our conversations with marketers and civil rights organizations are about how together we can be a force for good." But Julia, when you see Mark Benioff standing up here against Facebook, you have to suspect other companies, in addition to the ones that have already taken a stand, they will follow his lead.
Yeah, you know, it's interesting, Brian. He's been vocal on this for several years, as I was just mentioning, going back to the World Economic Forum in 2018. And I asked him basically, you know, how do you get CEOs comfortable with taking a stand on so many different issues, social issues and whatnot? And he said, really, you have to look inside at your own house and make sure you're, you know, living by your own values. So it's not, you know, okay, I'm a company CEO and I need to tell this other company CEO what to do. It's kind of like by making a stand and taking a position, it almost gives other company leaders the psychological permission to also take a stand and push for changes. All right, our very own Julia Roche, thanks so much. As we mentioned, one of the companies joining the hashtag Stop the Hate for Profit campaign is Upwork, an online platform that helps freelance professionals find work. Here with us now is Erin Thomas, Head of Diversity, Inclusion, and Belonging at Upwork. Erin, good to see you this morning. So walk us through the process here. Why was it so important for Upwork to join this campaign?
Sure, thanks for having me. You know, the decision for us was really simple. This is really, as we heard in the last package, about accountability. We are actively committed to being an anti-racist company, and that means that we have to make decisions that align with those values. So for us, it's about, you know, making decisions around with whom we do business and where we spend our dollars. And it's a direct fallout of our mission, which is to create economic opportunities so people have better lives. This was a no-brainer for us.
Erin, at the end of the day, though, what is the end game here? Because there's been a lot of news out there saying, yes, while this boycott is large, lots of big companies now saying they're going to boycott Facebook with their ads, but it's not really going to affect their bottom line. They say it's sort of a drop in the bucket. So if it's not going to affect Facebook sort of where it hurts, so to speak, what is the goal here?
Yeah, the goal for us at Upwork is to make the decisions that we're in control of. Of course, we can't control what Facebook does, but we can set real expectations and accountability for what they need to do in order for us to continue spending on their platform. This pledge and signing on to it and withholding our July spend is one of many actions that we're taking and have direct impact over in order to be a part of the change that we want and need to see in society.
Erin, I do want to spotlight something inside Upwork, the initiative you have been driving. In February, you had your first Black Excellence Summit. Take us through what this is, how did you stand it up, and how will this evolve in the future?
Sure. This was a day for me as a new diversity and inclusion and belonging leader within our company to really understand a data point that we had already identified as problematic. We were not seeing the retention rates we expected to see within our Black talent population. And so we really needed to curate a day to get all of our Black employees offline in a room together back when we could convene in large crowds and discussing what it was that underlay their experiences. When we coupled that day together with our internal research around departed employees and employees who had voluntarily left our company, we saw a real texture to the Black employee experience that we never would have unearthed if we hadn't really provided that safe space for folks to have really real, candid conversations. So the day was a day just for Black employees to build community with each other and share their experiences with us so we could understand why it was that we were seeing the attrition rates that we saw and could build data-backed solutions to stemming that tide.
What were some of the things you learned from that day? What are some of the takeaways, the actionable things that Upwork learned?
Yeah, one of our main pain points was really best identified as a misalignment between where employees thought they were and where others who were responsible for their professional outcomes thought they were. And it really yielded a distrust that the hard work that our Black talent was putting in every single day would actually pay off. Now, what's really interesting is although we haven't historically seen promotion rate differences between Black employees and their counterparts, we do see a large transparency and communication gap where we haven't done enough to be really clear about what success looks like at our company, to hold ourselves consistent to those standards across individuals, and to proactively communicate those outcomes to our workforce. And so, through all of this, what we've really learned is we have to be a lot more transparent, a lot more vocal about the decisions that we're making so that everyone has insight and can trust in us again.
Erin, how could large corporations put events like this together? Very important. I feel as though a lot of big companies, they have online training programs and they keep it moving. They're not really engaging with employees, but you may have hit on something very important here.
Yeah, that's exactly right. I think one of the quickest sort of band-aids around racism or inequity within workforces tends to be a training. This is not about a training. We're really talking about getting to know your people and the nuances to their lived experiences. And so, I think the first step to curating a day like this would be centering the very populations that you're trying to affect. That means talking beforehand with members of that community to suss out what it is they want to see from that day, to design that day with a very proactive lens on, an effective curriculum design. And there are many experts who can help you kind of shape that structure. But that day has to be for the people. And through, centering those employees, you can start to draw out experiences that you never would get from a survey, that you're not going to get in the course of day-to-day work. And so it's about creating that space, that intentionality, and having someone facilitating that day that people can trust. And, I think that has to happen on the front end. Otherwise, you're never going to get people to open up.
All right, let's leave it there. Erin Thomas, Head of Diversity, Inclusion, and Belonging at Upwork. Tremendous work you're doing there. Looking forward to staying in touch with you.
Thank you.
All right, do stick around. We'll get back on the markets on the other side of the break. All right, welcome back to the first trade. Let's get right back to Inez Ferre for a look at the markets. Inez?
And Brian, financials are leading to the downside. Take a look at the Dow. The Dow is down about 460 points. Leading to the downside are Goldman Sachs, down more than 6% this morning. Also taking a look at JP Morgan, that's in the red as well. This is after the Federal Reserve imposed a dividend cap on banks following those stress tests. I do want to mention Vaxart because that stock is soaring this morning after revealing that the Trump administration selected Vaxart as part of its Operation Warp Speed, meant to speed up the development of a COVID-19 vaccine. Vaxart is working on an oral vaccine. And just take a look at this stock. Year to date, it's up more than 3,000%. And then just taking a look at Amazon, relatively flat this morning. Amazon secured the naming rights to Seattle's Key Arena. It will now be called the Climate Pledge Arena, pushing forward its climate initiative. And then just taking a look at Luckin Coffee, that stock is down 54% after Luckin Coffee said that it withdrew its request for a hearing with the NASDAQ to try and keep the company listed on the NASDAQ. It will be delisted on Monday following its accounting scandal. You can take a look at what happened to this stock year to date. Back in April, this is when that scandal was revealed through an internal investigation at the company. Stock hasn't recovered. Brian?
All right, thanks so much, Inez. A major event on the U.S. equity calendar happens today after the market closed, the Russell 2000 Index reconstitution. It is typically one of the highest trading volume days of the year in U.S. equities. Joining us now to discuss is Market Gauge Director of Trading Education, Michelle Schneider. Michelle, good to see you again here. So what should investors expect after the close?
Well, this is an event, as you said, that happens every single year. And quite honestly, it's not been an event that has really highlighted in terms of an average investor, but it's important to hedge funds as they will trade ahead of that in anticipation of what gets added into the Russells and what gets deleted. But this year becomes even more interesting because we're in a COVID-19 situation. So we could see a little bit more volatility as a result, particularly in certain sectors.
Now, I want to talk about that a little more, Michelle, because which sectors do you think are most at risk of getting kicked out of the index? And conversely, which ones do you think might actually see their share increase?
Well, I believe that financials and energy would be the sectors that are at most risk. I mean, not only have they been most impacted by the COVID-19, but then as you just said earlier when I was listening to your reporting, the financials are getting hit heavy today anyway, so they've had their own host of problems. But since this is really basically a number crunching, it's really what's happened up until this point. So I would say financials and energy would probably have the most risk, where healthcare and some technology would have the best chance of being added into the Russells.
Michelle, I do want to get your thoughts on the market more broadly. We just had a guest on earlier on that put a pretty stark number on things here. If we do not get a stimulus package come July, another stimulus package, we could see the market fall by 20%. Would you agree with that?
Well, this is a very interesting market because we've had a lot of stimulus and a lot of hope for stimulus and a lot of talk that stimulus will continue. So I think right now what we're seeing initially here is a reaction to what happened with basically, the government giving and then the Fed taking away in the financials. Yesterday, they relaxed some of the restrictions on the Volcker rule, allowing banks to make more investments, which of course has gotten banks into trouble in the past. And then the Fed came out and said that they were lowering the dividends and then also not allowing corporate buybacks. That may be a little bit of a straw. But I also believe that we went up. If we just look at the S&P 500, we went from 2,200 to 3,200 from March into the peak in June. So I'm not sure this is going to be a major collapse, but more of a probable correction. And part of the reason is that even though the virus cases are going up, I think the market is really going to measure how much risk is involved, not on the cases, but on any change of rate in the deaths. If the death rate that we had in the initial first wave stays the same or decreases, the market will consider that to be a relief. And I know that sounds harsh, but the market, of course, has no compassion. It's just the market.
Michelle, what about investors wondering about ways to re-risk their portfolios after the pandemic? Should they consider increasing allocations to U.S. small cap value stocks?
Well, there has definitely been a exodus from growth into value as a general theme. Of course, there's been volatility within that too. But that's actually going back to the Russell reconstitution. Something that we would look for is what value stocks make it into the Russell 1000, 2000, and 3000. So like, here's a perfect example. Today, FuelCell was put into the Russell 3000, and that's just a very small $2 stock, but it's a stock that has to do with really fueling electric cars. So, you know, that's really something that you want to look for, is what in terms of the value stocks would actually join the index. And this is where it could be very valuable to people who are looking for new stock ideas. And value would certainly be a place to look. As an overall general theme, if we have a major meltdown, everything will be affected. But once the dust settles, then value could be a good place to look, as well as some of these other growth stocks that have done very well, particularly in the technology sector and the work at home theme.
All right, let's leave it there for now. Market Gauge Director of Trading Education, Michelle Snyder. Good to see you again. Have a great weekend.
Thank you. You too.
All right, do stick around. Much more ahead on the markets on The First Trade. All right, welcome back to The First Trade. Big day for grocery chain Albertsons, which will finally IPO. Finally. All right, Inez Ferre has all the details. Inez?
And Brian, Albertsons priced its IPO at $16 a share. The indication we're getting right now is for it to open anywhere between $17 and $18 a share. It will open under the ticker symbol ACI at the New York Stock Exchange. And Albertsons is just a huge company when it comes to grocery stores. It has over 2,500 stores. It has different names in its portfolio: Safeway, Albertsons, Bonds, Acme. These are names that we've all heard. Also, I want to mention that the timing of this is very key during the pandemic, when food sales are up as more people are shopping for cooking at home. And in their S1 statement, the company said the coronavirus pandemic has significantly increased demand for food at home, particularly through our e-commerce offerings. The company says that it has accelerated its drive up and go service, accelerated its service through e-commerce during this time.
All right, thanks so much, Inez. Alexis?
Thanks, Brian. COVID-19 has forced a number of events to be pushed back or canceled. But for the 50th anniversary of the Pride March, many Pride celebrations have continued on, going virtual, of course, this year. Joining us now to discuss the economic impact of this is Jonathan Lovitz, Senior Vice President of the National LGBT Chamber of Commerce. Jonathan, good to see you. Arguably, the fact that a lot of these events are going to be virtual means more people can see them and participate. But what does it mean on the ground for the economies of the cities and states that we're going to be hosting these events?
Great to see you. Happy Pride. Yeah, absolutely right. That is such an important point, that having these Pride celebrations be virtual, Pride Inside, as so many people are calling them, does mean that more LGBT youth, more LGBT seniors, more people with different abilities who maybe have not been able to access Pride celebrations, particularly digital learning experiences, are going to get to see what makes this community so special from wherever they are in the course of this recovery. But you're right, the economic impacts are massive. So everyone's aware, LGBT businesses in the United States, all 1.4 million of them, contribute over $1.7 trillion to the U.S. economy every year. And just like every other major economic force in this country, we've taken a major hit due to both COVID-19 and the supply chain implications that have happened ever since. So we are seeing so many great LGBT-owned businesses that do power our economy pivot in ways that are not only helping power virtual prides, like supplying the digital tech that's needed to run them, creating pride kits that people can celebrate at home or in their offices with swag that is purchased from the community, for example. We're also seeing them pivot to ways that are helping people enjoy Pride and the entire safely, like a great lesbian-owned distillery in the DC area that we work with that has converted several of her stills to creating hospital sanitizer and cleaner. So there are a lot of different companies out there doing things that are not only going to make Pride safer, but our whole economic recovery better and keep money flowing into the LGBT economy in this country.
Jonathan, what have you been hearing from the LGBT business owners the past 3 months? It's been challenging times for many small business owners because of the coronavirus pandemic.
And so many things in the LGBT community always feels like we're quoting, it was the best of times, it was the worst of times. We are in the midst of one of the large upswings of certifications of LGBT-owned business enterprises in the country. We are seeing greater investment from corporations and funding than ever before. And yet, like every other small business community, LGBT-owned companies are hurting. But thankfully, they are utilizing both PPP, they're using private loans, they're using bridge capital, whatever is needed to keep their employees on, and that their companies are strong in serving the communities where they live. And particularly important because remember, LGBT-owned businesses, LGBT people in America aren't monolithic. We're women, we're people of color, we have disabilities, we're veterans, we are immigrants. We are every community that has always and will always make this economy and this nation great. So helping LGBT businesses recover through this crisis is in fact helping the entire country do better. So people are scared, they are recovering, and they're taking good care of one another, making sure they share resources and opportunities with the entire community.
Jonathan, but the LGBT small business community, are they facing different or unique challenges versus other small businesses during this pandemic?
That's such a great question because, we're all still, today, June 26th is Marriage Equality Day. So we're reminiscing on one of our favorite historic moments in LGBT and really in American history, just a week after the Supreme Court decision affirming that we are protected in our workplaces. But that does raise the question, well, what's still to be done? And to your point about helping business owners in this recovery, yes, we are affected differently because as we know, whether it's in the course of the COVID recovery or any other type of small business situation, access to capital is every entrepreneur's #1 need. And yet in 36 states in this country, it is perfectly legal for a branch manager or a loan officer to say, we do not give money to your kind because there's no law that says we have to. That's why we need the Equality Act passed to make sure that your zip code doesn't dictate how successful your business is and how safe your family is. So there is a major economic component to full civil rights for the LGBT community in this country.
All right, we're going to leave it there. Jonathan Lovitz, National LGBT Chamber of Commerce, Senior Vice President. Good to have you here, and happy Pride Day.
Happy Pride. See you again soon.
All right, stay with us. We're going to take a closer look at that brand new F-150 pickup from Ford and what is worth $70,000. We'll be back after this.
All right, welcome back to the first trade. Ford is looking to raise the stakes by building its toughest F-150 yet. The 2021 model has a ton of new features as the most popular truck in the auto industry is seeing increased pressure from competitors. Yahoo Finance's auto expert Praz Subramanian joins us now. Praz, I know you have a large following and people know you as really testing Rolls Royces, Bentleys, Lamborghinis. So surprised to see you talking about the F-150. What are some of your early takeaways?
You know, Brian, surprisingly, I am a huge pickup fan. I do like the F-150. I do like pickups in general. So it's not just the nice fancy cars. But, you know, my initial take, Brian, I wrote about this yesterday and this morning. Look, I think this is all in response to one big competitor. But let me begin with the new Ford. The F-150 is, they're saying it's brand new, all new. You know, you take a look at it, it doesn't look that new because the exterior styling elements are pretty, you know, tame, if you ask me. Some LED lighting here and there, it's okay. But I think the biggest stuff is like the new hybrid engines, the new hybrid V6 in there that it's going to be the only pickup truck that has a hybrid engine, which is kind of a big deal. But here's a part where I think that they're really making a push is with interior and technology. All new interior. The seats are kind of almost like ultra luxe. This is all in response to the Ram 1500, which is with its best-in-class comfort and creature comforts and interior technology. You know, Ford is also offering this big touchscreen, like just like the Ram has. You can actually fold the console down and make a work table to eat and actually use your computer on. You can actually, on some models, recline the seat fully like a first-class airline seat. So you know, this is kind of responsive owners wanting to have more the ability to kind of just hang out and live in their cars, especially in a post-corona world. It's a big deal. So I think a lot of these things combined are a response to the competition. I think Ford is responding to that.
Yeah, for sure. You know, we spoke to the COO, James Harley, earlier, and he said the same thing, or Farley rather, sorry. He said the same thing, that more people are spending time in their cars, not driving, right, but sort of just living in them. And he said that this F-150 is fundamental, he actually used that word, to the company's turnaround. The fact that they're not going to have an electric truck out for the next few years, and you have companies like Tesla and Nikola, you know, hot on their heels. What does that mean for Ford? Are they going to lose their leadership position among pickup trucks, do you think?
You know, it's funny, they teased an all-electric F-150 about a year and a half ago, and we all thought we might see it tonight or last night, and they didn't show it. So I'm a little concerned that we have not hearing more about this electric pickup when you talk about Nicola's Badger, you talk about the Tesla Cybertruck, and let's not forget Rivian. Rivian's really highly anticipated pickup truck supposed to come out this year. It's got pushed to 2021 because of Corona. So that's a big one that many people are looking forward to. And guess what? Ford invested in them. So maybe we'll see some sort of amplification of that relationship. Maybe Ford will be able to pull some of that technology from Rivian into a new electric F-150.
Pras, why are people just love these trucks? The best-selling pickup truck in the U.S., 43 straight years? Why are they obsessed with every F-150 that comes out?
Well, Brian, it's also the top-selling vehicle in America, period, right? And I think it's because I think Americans, especially maybe older men who tend to buy SUVs and bigger trucks, are actually thinking like the pickup's cool now. Like I want something different around the block. I want something different that I take to the mall. And a pickup is offering all the things that you'd like in a high-end SUV, plus a little bit more, practicality maybe with an open bed to go to Home Depot, load up some 2x4s and some soil. And it's got a cool factor. So I think that's what's happening. It's all American, it's cool. And I think you're getting a lot of suburban, older type of buyers going in there and saying, I don't want that SUV, I want this F-150.
What about what's coming down the pike? They're going to have that new Bronco coming out. How excited are you for that, Pras?
The Bronco name is really big in the auto world, and a lot of people love those old school trucks. What we're seeing in terms of the spy shots and the intel we're hearing, it's going to be like a response to the Wrangler. It's going to be a kind of SUV that you can take anywhere, take the top off, probably come in a smaller and a bigger size. So anything that kind of helps that sport utility, that really kind of sport active utility product range, I think is interesting for the auto world. I think that's where people want to be. I think people want to do vacations where they drive the car out somewhere and they're not in a city or not in a hotel. They're out in the middle of nowhere. I think that might help. So I'm excited to hear about it, to see about it. But Wrangler is the top in class right now. So we'll see if Ford can actually take it to them.
All right, I'll leave it there. Yahoo Finance auto expert Pras Subramanian. Give him a follow on Twitter and read his latest piece. I think he just reviewed a new Mercedes G-Wagon. It looked really expensive, Pras.
It was way more than I could afford.
All right, thanks so much. All right, let's get back to Inez Ferre for a look at the markets. Inez, the markets are really taking on the chin here, but Facebook getting blasted.
Facebook right now getting blasted down more than 6%. You take a look, 6.5% right now. And more companies have added to the list of boycotting ads on Facebook for the month of July. I also want to mention what's happening with Amazon, because Amazon has announced that it has bought the startup Zook. It is acquiring the self-driving startup, and this deal was expected. Zook's current CEO will continue on that role. The company's co-founder and CTO will also continue in that role again. You guys were just talking about pickup trucks. Well, we're also watching Tesla this morning, down about 2%. This is despite a price target raise at Deutsche Bank to 900 from 850. Well, the stock is trading above that with a hold rating. Investors will be paying attention to the production and delivery numbers, which are expected to come out next week. Usually Tesla does this a couple of days after the end of the quarter. And then just taking a look at Virgin Galactic, that stock not moving too much. Virgin completed its second glide test in New Mexico yesterday, and now it will review that data and then prepare for full rocket power test flights. Remember that Virgin had anticipated that it would start becoming commercially operational this year with the first flight with Sir Richard Branson on his birthday. His birthday is in July. Of course, this was pre-pandemic. And then we're just watching to see where Albertsons will start trading. Albertsons IPO is today. The company price, it's at the IPO at $16 a share. In 2015, it had filed to go for an IPO as well, and it dropped those plans back then. So this time around, it's happening.
All right, and it's just such an important move you're seeing in Facebook with the stock down more than 7%. Finally, the stock seems to be responding to potentially the company losing a good bit of advertising revenue. All right, thanks so much, Inez. I appreciate it. Inez mentioned the Albertsons IPO, and do stick around for On the Move. The On the Move team will be speaking with Vivek Sankaran, Albertsons CEO, on their IPO. Important to note that Vivek is a longtime PepsiCo executive, so certainly he knows about the grocery space. That's straight ahead.
I'm Adam Shapiro along with Julie Hyman, and we are watching markets sell off. The sell-off accelerated just about 30 minutes ago when Texas Governor Greg Abbott announced that he was rolling back that state's reopening plans. Again, we're going to talk about that in just a second. We should also let you know that cases of coronavirus in Florida rose at a rate of 7.8% versus the previous 7-day average of 4.1%. In about 2 minutes, Angelique Kamlani is going to break all of this down for us and what it means. There were headlines that came into this market with some optimism. Personal income in May, it fell 4.2%, which was better than the 6% drop analysts had expected. Consumer spending in May rose 8.2% after crashing 13.6% in April. Nike reported a 38% decline in sales year over year for its fiscal fourth quarter after the coronavirus pandemic forced stores to close. We're going to talk about their revenue picture. 30% of their revenue came from digital sales. Shares of Gap, they are rising, or at least in the first part of the day, they were rising more than 30% on news that Gap was entering a multi-year partnership with Kanye West to produce clothing for West's popular Yeezy line. Forbes reported that West became a billionaire in part because of Yeezy's partnership with Adidas to make and sell basketball shoes. The U.S. set a daily record, by the way, for COVID-19 cases yesterday, 40,141. The previous record was set in April at 36,291 cases. Also, we should point out that late yesterday afternoon, the Justice Department asked the Supreme Court to invalidate the Affordable Care Act, or Obamacare. As we look at cases of COVID-19 and coronavirus worldwide, the number testing positive, 9.6 million, the number of dead, 489,000 plus. In the United States, 2.4 million people have tested positive, with the number of dead now exceeding 124,000. Angelique Kamlani joins us with more on what is going on and how this, the outbreak, I guess you could call it, in states that had started to reopen, really stalling.
Yeah, Adam, and this is something, if you go back and remember those regular White House coronavirus task force briefings that we used to hear, this is exactly the scenario that they played out in terms of worries of what would happen if we A, reopened too soon, or B, if the virus hadn't completely gone away or been flattened, if the curve hadn't been flattened by then. And so what we're seeing now is just a result of that, quite honestly, looking at states like Florida and Texas really having those record-breaking numbers, Florida reporting nearly 9,000 more cases in a single day. And as you mentioned, the US hitting a record. And we're looking at all those concerning states, Texas, Florida, California, Utah, North Carolina, and Georgia as well. And these are, some of these states are those that have either reopened too early or were looking to push ahead, even though they didn't quite have a grasp on what was going on. And so we've seen that as a result of Texas Governor Greg Abbott also saying now that they are going to roll back the reopening, citing things like congregating in bars as a reason why the virus is spreading. And so with that, it really just puts a pause on that, as well as we know that in Miami recently, they were pausing there. So we have seen that, in phases, and it's likely we're going to see more stricter rules coming down from other states as well.
Angelique, thank you. We want to stick with how COVID-19 and coronavirus, the pandemic, is impacting investors worldwide. Seema Shah is the chief strategist and principal global investors, global investment strategist, joining us now. Seema, it's good to see you.
Nice to see you. Thanks.
I want to start with something that you pointed out, which is that a second wave of infections, at least in the summer here in the United States and Northern Hemisphere, shouldn't be too troubling as the first wave, and yet we hear from people like Dr. Fauci that we're still in the first wave. Can you help us see more of what you're telling us?
Yeah, sure. So I think what I mean by that is, in terms of the economic impact, it shouldn't be as awful as we saw in March. And the reason I say that is because we're looking more at localized shutdowns. We're not looking at nationwide lockdowns. We do think that as the virus has continued, medics have learned more and more about how to control the virus. So even if there is a big second wave in the winter this year, then hopefully it shouldn't result in a nationwide lockdown. And certainly that's what the market has been pricing in. Now, the renewed cases in the US, I would actually class that as a continuation of the first wave, as a result of maybe premature opening. So you could see, as we just heard, that this is going to change a little bit of the policies the government has been bringing in about reopening.
Hi, Seema. It's Julie here. Just as you're talking about, we might see regional sort of effect from coronavirus. Are we going to see also a return of more sector differentiation, right? Because we were seeing that when the pandemic really started ramping up. And then we saw a big recovery, and particularly the beaten up names. But with this renewed case rise, and also with the EU considering this travel ban on travelers from the US, could we see that comeback of sector differentiation?
Yeah, I think so. I think it's been a timely reminder that there is still that trade-off between economic activity and the virus. So in those sectors, such as the entertainment, leisure, airlines, these are still going to be concerns for us. It's one of the reasons why we've maintained our preference for more of the defensive sectors, such as technology, which are less affected and actually in some ways benefit from the kind of shutdowns that we've been seeing. So absolutely, I think that's the case. And I think with, there's also regional, from a global perspective about how this may play out. And you can see more and more people talking about the potential for a European catch-up, partly because it seems like the cases have been managed a little bit better in Europe, partly because it's just taken a little bit longer to open. They've waited for the curve to really flatten before they've opened up.
Seema, I'm wondering, as you look at the developments around the virus, what type of data really poses the biggest risk to markets, right? I mean, is it in cases, increases in certain regions, increases in deaths or hospitalizations, or is it really just when policymakers actually impose broader restrictions or roll back some of their plans to reopen because of the resurgences?
Yeah, that's a really good question, and it's something that we've been talking more and more about in the last week or so. So originally, I think that what people were closely following was death rates. That gives you the clearest indication of where the virus is going. Now, what we're seeing with the US is actually hospitalizations and death rates haven't increased that much. It's really about the case of cases increasing. So that brings you to looking closer at what are the governments, how are they going to be responding with regards to nationwide lockdowns. But the other thing that we have been thinking about more and more is, as we're learning more about the virus, you're finding out that actually a lot of people who suffered the virus and then recovered are being left with longer term health illnesses. So we think that actually maybe you could see in a couple of months' time market attention returning more to the number of cases rather than death rates. So look, it's still an evolving issue. We have a huge amount of uncertainty. And I think that what we have just been reminded of, at least in the last week or so, is that it's how this virus evolves, how much is it being contained. That's still going to be the main driver for markets for the foreseeable future.
Jared Blickery here. You just brought up a great point in that, and I would just want to kind of build on it. We threw preventative care out the window for a few months here, and not only people whose health are affected negatively by COVID, but just by the lack of preventative care over a period of time. And then you have people who are afraid to go to the ER for stroke and heart attacks. What are some of those lasting impacts and any specific sectors in the market that might affect?
I think it's difficult at this stage because I think what we're learning, and of course I'm definitely not a medical expert by any means, but I think that what we're learning is the kind of, it's so widespread, the lingering effects of this virus. But what it does mean is that as we learn more and more about this, the people who've been considering themselves quite healthy and therefore are not as worried about catching the virus are maybe going to have second thoughts about that. And then the implications of that is it can continue to weigh more on household behavior. So, what is that return to normal? When are people going to feel comfortable about going around the normal business that they had before? So as we start to hear more about health effects that are long lasting, you could see some more caution actually creeping back in. And that's going to have a significant impact on markets potentially.
Seema, let me ask you about that normal behavior, because if you push COVID to the side, we've got huge debt overhangs at the government levels globally. We have deglobalization underway, and you have, those of us who are just basic consumers might be afraid of tapping our savings. What does that mean going forward?
I think as we look beyond the kind of next year or so, I think the debt issue is going to be the most important one that we're going to be facing, because somehow governments are going to need to pay this back. And either it's, typically it's either through taxation or you try and grow your way out of it. Now, growing your way out of it unless there's a vaccine, it's going to be quite tough because households are simply not going to be back to normal. So this brings you into slightly murky territory with regards to inflation, what central banks do. It's going to be difficult. I think the problems are going to be more in the emerging economies rather than developed economies. But it's something that we're going to have watch very closely. And as regards the supply chains, we are hearing more and more about companies deciding that it makes more sense to try and think more about onshoring. So there could be some ramifications for emerging economies, especially from an investment perspective.
Seema Shah is Principal Global Investors, Global Investment Strategist, and we appreciate your insight here on The Move. Turning our attention now to Facebook and another company, our parent company, Verizon, among those which is pulling its advertising from Facebook until they address issues that have to do with the way Facebook manages comments that people make that might be considered racist or that might actually just be false. Want to give you a quick quote from Facebook. "We do not make policy changes tied to revenue pressure." That's from their VP of Global Business. Bill Wise is the CEO of Mediaocean, and he joins us now. Thank you for being here, Bill.
Thanks, Adam. How's everything?
Pretty good. I am curious. I don't know if you can share with us, but what is this going to cost Facebook? Because Verizon, our parent company, isn't the only one. Ben & Jerry's is part of this. Other companies have said no more till you fix it.
Yeah, so North Face was the first major brand that said they weren't going to, they were going to stop. And the interesting part, after North Face announced it, REI, Patagonia, Eddie Bauer all jumped on ship, right? Verizon, as you mentioned, they found their ad next to a video, that was based in hate crime and bigotry. And, and for years and years, Facebook has had the same stance, which is, hey, we're a technology platform. We're not a media company. We're not going to monitor the content. That's based on the users. In this day and age, I'm not sure Facebook can hide behind their tech platform stance anymore. But to your point, 900 brands have said they're going to boycott Facebook and Instagram. But don't forget, Facebook has 7 million advertisers. 7 million. So even if 900 sounds like a lot, they have 7 million advertisers. So, their stock is down 2% so far today. It probably isn't going to have a material impact unless it really catches on.
Well, and Bill, it's Julie here. Hey, but of those enormous number of advertisers, there aren't that many that are large, right? Like a Verizon, like a Patagonia, for example. I imagine some of them are on the smaller side. So perhaps it wouldn't take quite as much critical mass to make more of a difference. I mean, just to give folks an idea of where you fit into the ecosystem, right? You all provide software for the companies that are advertising, whether they be ad agencies or companies like Verizon, for example. What are you hearing from them, if anything, even the ones who haven't signed on to this yet? Is there sort of a rising tide of discontent?
Yeah, Julie, you're right. The what I call the Fortune 2000 or the top 2,000 marketers in the world, they represent roughly half of total ad spend. So very few of them, Verizon being the largest, just announced, I believe it was yesterday, that they're pulling back. If those Fortune 2000 all start jumping on, it's going to have a material impact to Facebook's revenue. Don't forget, Facebook does 70 billion of revenue, 90% of which is advertising. So, it's those Fortune 2000 brands that control half ad spend, but there are millions of advertisers that represent local, direct response, and very few of them so far have backed out. And that's a significant portion of Facebook's ad revenue as well.
When you take a look, though, at the companies that have decided to back out, right now it looks like it's just going to be through July. No word yet if that's going to be extended. And I'm wondering, in your opinion and what you see from what these customers get in terms of customer acquisition from advertising on Facebook, whether it's feasible for them to actually pull their ads for longer without necessarily repercussions on their own businesses?
Facebook has proven to be one of the single best inventory sources for performance. So if you are a direct response oriented marketer, Facebook is near the top of the list. And that is why so many of the direct response oriented marketers are reliant on Facebook. So yeah, it's going to be really interesting to see how this plays out. I believe direct response will stay on. That's a significant portion of Facebook's revenue. If there are more companies like North Face, like Verizon, they could be in for a rude awakening, and maybe they'll start questioning their policies a little bit.
Bill, when you talk about, I think it was 70 billion was the figure you just put out for revenue that Facebook generates. What's the breakdown versus Instagram and Facebook? Do they separate it for us? And do they risk alienating that younger user that they're so reliant upon for Instagram?
So, we believe Instagram is roughly 20% of Facebook's revenue. And there aren't a lot of major brands really investing significantly in Instagram the way they are on Facebook.com. So, but again, we have seen through the social movement that the younger generation is faster to ban things and make decisions. So Facebook really does not want to alienate, the younger generation.
What would you say to Facebook Zuckerberg? I thought, and I thought perhaps incorrectly, that Facebook was for older folk, the generation that had rotary phones when we graduated high school, and that younger folk were abandoning. But everything you've said to us is that's not the case.
It's not the guy. I would urge Mr. Zuckerberg to rethink, his obligation. I look at Juneteenth. Juneteenth has been going on for years. Even 10 days before June 19th, there were very few companies that were acknowledging it. Within the matter of days, every single major company made it a company holiday. We could see a movement within Facebook where marketers decide, you know what, until Facebook changes their policy and gets rid of hate crime and starts auditing a little bit, which they have the power to do, we may start pulling dollars, and that would be detrimental to a company whose revenue is 90% advertising.
Bill Wise is the CEO of Mediaocean. Good to have you here on The Move.
Thanks so much.
So did you see what happened with Nike? They reported earnings for the fiscal fourth quarter, and they reported a 38% decline in sales. Digital sales, though, increased 75%, 30% of their total revenue. All of this has to do with the coronavirus pandemic. And by the way, Nike says that 9% of its stores worldwide have reopened. Julie, what do you take from this? When they tell us the obvious, we knew they would take a hit. Is this worse than perhaps people thought?
It is worse than people thought. But what's interesting is I was looking at some of the analyst research this morning, and they're remaining pretty bullish on Nike. I think some of that has to do with the consistent operations that the company has had, right? Before this, it is a very consistent performer, and analysts say that the brand remains strong as well. Something else that they're pointing to is Nike's inventory position. The company made some comments around inventory, which I think they said was 31%, up 31% year over year in its fiscal fourth quarter. Remember, it doesn't operate on a calendar year, and that it will be able to work down that inventory in the current quarter. What's going to be interesting, according to some analysts, including Simeon Siegel over at BMO Capital Markets, who's a frequent guest on the show, he says you're going to have to watch what he calls the promotional cadence. In other words, how much are they going to have to discount to move out that inventory?
Well, what I found interesting just looking at this report too is how much of a reversal we saw versus what we saw in the fiscal third quarter, because at that time, that's when all the store closures in China had taken a hit on sales, but Nike was actually able to offset that with a surge in digital sales. But this time around, that surge, even though it was a 75% increase over last year, wasn't enough to completely make up for the decline elsewhere. But again, there were more widespread store closures. About 90% of physical stores were closed for about 8 weeks during the fiscal fourth quarter. And then the last thing I want to point out too is that Nike isn't providing specific guidance yet, but it did say that looking for the next fiscal year, for fiscal 2021, they are expecting a rebound in sales in the second half to be little changed or possibly posting a slight gain over what they saw this year. So that's potentially some green shoots to look forward to for next year.
Yeah, and I'd just kind of add to that, digital sales growth is good. They're seeing a fledgling recovery in China, and the stock is only off about a few percentage points year to date. And let's take a look at that right now in the Wi-Fi Interactive. And the chart largely, this pattern right here, if you were to juxtapose it with the S&P 500, very similar. But I will say over the long term, this has been a very strong play for the reasons we've been talking about. And just taking a look at the apparel industry overall, so we have this heat map here. Check out year to date. It's just been a disaster for most of these guys. Lululemon is the big standout here. up 26%. But you can see Nike down only 6%, comes in number 2. Compare that with some of the other real losers in the industry like Express, Tailored Brands, down 70%. And it's been a really bifurcated market here with few winners this year.
And Jared, the best thing about Nike is it's easy to pronounce, no controversy like Adidas or Adidas.
Or Yeezy.
Which is it? I think the Germans always say it's Adidas, but I don't speak German. When we come back, we're going to go to Brian Chung to find out what message is the Federal Reserve telling all of us when they tell the banks, don't you dare raise those dividends. Welcome back to Yahoo Finance on the Move. We're watching a sell-off. The Dow is off more than 500 points. The other indices are also falling. But take a look at what's happening with bank shares. JP Morgan Chase down about 5%. Citi is off. Bank of America is down. Wells Fargo down. All of this part of the response to what we heard from the Federal Reserve yesterday. Brian Chung is going to help us understand what the Fed is signaling when it prohibits the banks from raising their dividends going forward and much more. Also, decisions on share buybacks. Brian?
Well, Adam, it seems like all of us could use a good stress test right now, but especially the banking industry. Now, the Federal Reserve has run this even before the COVID-19 crisis. They do this annual test where they try to make sure bank balance sheets can withstand a severely adverse economic scenario. One interesting factor here, though, is that the Federal Reserve announced the terms of this severely adverse scenario before we reached the COVID-19 crisis, where unemployment and GDP is actually worse than what the Fed had originally modeled. So alongside this year's regular stress test, the Fed also added what they call a sensitivity analysis, which is modeling out a U, a V, or a W-shaped recovery to see where the banks would stand under those theoretical scenarios. What the Federal Reserve found that the banks or several banks might approach regulatory minimums but wouldn't breach those minimums. So the Federal Reserve saying that overall banking industry does appear to be okay, but because you have a number of banks that might reach their regulatory minimums under these various scenarios, they did impose a restriction on dividends. They can't raise their dividends, nor can they pay out dividends higher than the average of the last 4 quarters of income. They will also be suspending share buybacks for the third quarter. Now, again, both of those restrictions are for the third quarter of this year. Beyond that, the Federal Reserve said it could extend those restrictions if it felt necessary, and that it can also do more stress testing based on the threat of the virus in the future to the U.S. economy. But the Federal Reserve saying overall that the banks did appear to have enough capital, but the Fed wants to be careful here by suspending those buybacks and capping those dividends. Adam?
And Brian, actually, I have a question for you. I believe that they're going to have to produce another one of these reports to the Fed later this year. Even though on the face of it and in its entirety, the banks look solid at this point, but usually the Fed gives us some bank specific analysis, right? Are any of the banks they examined sort of more on the cusp? I know a bank like Wells, for example, in the past had some dicey moments, shall we say?
Yeah, an important distinction that you make there. So all the banks will be required to resubmit their capital plans. This is the plan that they have for what types of capital distributions, dividends, buybacks that they'll have in the future. But as you mentioned, each bank does perform differently under these stress tests. Now, on the actual stress test that is annual, they did release it on a firm-by-firm basis. None of them breached their regulatory minimums. There is no pass-fail for these stress tests anymore. So there won't be any implications if you come closer to the regulatory minimums than others. But again, none of them breached that. But on the aggregate, we have to remember that the sensitivity analysis that they did, that UVW-shaped stress test that they ran on this that's unique to COVID-19, they didn't release that on a firm-by-firm basis. They actually did that on an aggregate, and they said they didn't want to out certain banks. It's possible that some under those scenarios, which were more dramatically difficult than the regular stress test, it's possible that a few of those firms could have been below that threshold. But the Fed, if that were the case, did not announce which banks those were. Now, as we go through the next few months, the Federal Reserve is going to work with these companies to try to figure out what the proper capital plan will be. This is one of those few industries in the United States where they have to get regulatory approval before they do dividend or buybacks. But again, as the Federal Reserve has very clearly stated, for the third quarter, it really wants to cap those dividends. One other thing I really want to point out quickly is that that wasn't a unanimous decision. You had Fed Governor Lael Brainerd actually saying, why should we be allowing banks to pay dividends at all for suspending buybacks? Shouldn't we also ask banks to conserve capital by holding out their dividends? She was ultimately outvoted by the Fed board.
Brian, thanks for the insight on that. When we come back, we're going to address the Dow falling more than 500 points. Going to look at the way companies are valued, but also the changing impact of those valuations on indexes like the S&P 500. Welcome back to Yahoo Finance on the Move. One of the reasons markets are selling off today are the news headlines we're getting about coronavirus. Arizona now reporting that cases have jumped 5.4%. That's above their prior 7-day average of 2.9%. And of course, within the last hour, we heard that Texas is rolling back, not stopping, but rolling back some of its phased reopening. So we're going to be hitting all of that. But right now, we want to invite into the program Tim Kohler. He is McKinsey & Company's corporate finance practice core leader to talk about several issues that are at the core of what investors try to determine on a regular basis, which is what is the value of the company or the stock I'm about to buy, but also the impact that's having as the different indexes like the S&P 500, their compositions are changing. So, Mr. Kohler, welcome to the program.
Thank you, Adam.
What is the hardest part in a period like the one we're in for an investor or from your company when you're trying to figure out the value of the asset you might be buying, especially in these times?
Well, I think the hardest part is it depends on what your strategy is, what your goals are as an investor, right? If you're an investor who are trying to sort of trade in the short term and make some money in the next couple of months or so, that's a different, then you're trying to figure out what the news is going to be. But for most investors who are thinking about their long-term portfolios, many institutional investors, what you're trying to do is to think about which stocks are going to survive the pandemic in a stronger position and thrive, and which companies are more likely to be the forces that we're working against them this is going to accelerate the negative impact on those companies. So it really depends on what you're trying to accomplish. If you are a long-term investor, though, you're really trying to figure out the longer-term impact on these companies, and that's why you'll see that the impact on the stock market varies so much from sector to sector, because the long-term outlook is very different from sector to sector.
Tim, it's Julie here. So for those people who are trying to look further out, is the current way that we value companies broken? Do we need to look either more expansively at what growth can mean for a company, or do we just need to look at different metrics?
Well, I think that depends on what metrics you're looking at. I think that one of the things that we're seeing with the fact that the market overall is down only like less than 10% since the beginning of the year, means that the way longer term investors are valuing companies is actually working pretty well. If you do the math and you say, let's assume we had 2 years of disastrous profits, and then we got back closer to normal, but maybe not even at normal, and you sort of discounted those profits and cash flows back to the present, you'd see that the impact shouldn't be that great. And so what we typically see in a crisis like this or any kind of recession is the market reacts by having an enormous drop. And then the longer term investors who realize that this is short term or that the impact is short term come back in and bring the prices back up something closer to normal. So even though we have one of the worst recessions and one of the highest unemployment levels ever, the stock market is a little more long-term warning and realizing that within a couple of years, we're likely to be closer back to normal in terms of profit levels, and therefore the stock market as a whole isn't down as much as you might expect.
Jared Blicker here. I want to ask you about the effect of interest rates on valuation, your methodologies. We have not only short-term rates kind of pegged towards the zero bound here, but longer-term rates. The 10-year today reached 64 basis points. That's the lowest in a month. We see the 2s, 10s, the yield curve kind of compressing for the most part. What does this effect have on the sectors that you're looking at that are going to outperform perhaps if this trend continues?
Yeah. One of the things that's been interesting is that we've looked over a longer horizon because we've experienced low interest rates for over a decade now. And what we've found in our research is that the cost of equity or the returns that equity investors expect to change have become are fairly constant regardless of what's happening to government bond rates. 20 years ago, we used to always think that the government bond rate was the base on which equity investors wanted to earn a return on some premium over that. What we found, though, is that as interest rates have come way down and stayed down and been volatile at these very low levels, that hasn't had much impact on the way that equity investors are evaluating companies, or at least the sophisticated long-term equity holders. And in fact, if you believed that these rates were there for a long term and the cost of equity should be lower, we should see price earnings ratios in the high 20s, not in the mid to high teens. So it is interesting. It's a little bit surprising, but when you sort of reverse engineer share prices, you find out that the cost of equity, going back 30, 40, 50 years, doesn't appear to have changed very much.
You talk about in determining valuation, a company's commitment to something like environmentally and socially conscious issues. I'll give you a real world example, Royal Dutch Shell. They're making that kind of commitment. Whether they pull it off is another issue. So how do I today value them with things they're doing that are 20 years out?
Most of the longer term investors that we talk to are taking into consideration what companies are doing longer term. But they have to decide how material that's going to be. The reality of it is, if you discount something that's 20 years out in the future, the impact is going to be relatively small. So they're still doing, it's still going to have a relatively minor impact for a large oil and gas company, which is going to be basically a hydrocarbon company for a long period of time, all of them. So that's still going to be the biggest driver of their performance. That said, we do know that companies, by looking at the performance, do take into consideration the long-term impact of what they're doing. Other companies are doing things that will have a much sooner impact, and you can see that in their valuations. And you can also see oil and gas companies, for example, investors realize that there's a good chance that some of those assets that they have, some of it will be stranded, that their demand for oil will go down. They won't be able to sort of produce everything that all the reserves that they have. And the valuations already reflect that long-term negative outlook in their valuations.
Tim Kohler is McKinsey & Company's corporate finance practice core leader. We appreciate your being here on The Move. As we've been talking, just want to let you know that Albertsons began trading. They opened below the IPO, which was at $16. They opened at $15.50, trading still below 16 right now. We'll be right back.
I can sign off now.
Welcome back to Yahoo Finance on the Move. I'm Adam Shapiro along with Julie Hyman, and we want to take a look at news on the move right now. The U.S. Department of Education issued guidance yesterday indicating it will distribute millions of dollars in taxpayer funds to private schools. Congress authorized $13 billion to help public schools cover coronavirus pandemic expenses for low-income students. But Secretary of Education Betsy DeVos previously indicated that private schools, she said, should benefit from that funding too.
Well, Adam, Seattle's incoming NHL team and the WNBA Storm will be playing at the Climate Pledge Arena. Amazon purchased the naming rights to what has been known as the Key Arena. That's according to CEO Jeff Bezos. He made that announcement on Instagram. And the arena will be powered entirely by renewable electricity. And the NHL Seattle CEO told the Seattle Times that the arena's goal is to produce zero waste, source food locally, and eliminate all single-use plastics by 2024.
Costco says it will restore free food sampling stations at some of its clubs. Costco suspended the tasty freebies as the coronavirus pandemic swept the country in March. The restored sample stations will include prepackaged food and will be kept behind plexiglass shields. Bloomberg reported that 30 of Costco's more than 500 stores have brought back the freebies. A lot of us got into TV because of free food. Let's turn our attention to Ford. There's the old slogan, built Ford tough, quality is job one. And Jim Farley, their COO, was on Yahoo Finance early this morning talking about the redesign of the popular F-150 pickup. Here's what he said.
The F-Series lineup is the second most valuable consumer product, only second to the iPhone. So from a revenue and profit standpoint, it is fundamental to the company, and we poured our heart and soul into this product. We're number one for over 40 years in the US as the most popular vehicle. So it's not only important for Ford, it's important for the US.
And Prasad Romanian joins us now. He was part of the team that covers Ford and other vehicle manufacturers here, and they face competition from pickups from Dodge Ram 1500, don't they?
Yeah, I think that was the sort of target that Ford now has. I mean, they are the top selling pickup, top selling car in America, but the Ram has been creeping up on them big time. Ram sales up 18% last year. So, Ford had to respond, right? So the new F-150, we saw it last night, doesn't look that much different than the old one. But there's really a lot of things going to happen under the hood. The new hybrid engine, the only pickup in the country that offers a hybrid engine now for 2021. And then you have a lot of interior, like new interior, more comfortable, better seats that can recline fully. You have a workspace that turns into a table so you can eat and actually work on your laptop there. So they're kind of responding to what their buyers want, which is a car that can do it all, and also the kind of car you can, stay away from other people and kind of live in a car, which is like a post-corona kind of cause and effect here. So I think that's a big reason why Ford is updating a lot of the interior and technology. We're talking also about, possible, semi-autonomous hands-free driving on some highways. So it's Ford iterating and updating that F-150 in response to competition, but it's not a drastic, throw out the baby with the bathwater kind of thing.
Hey, Pras, as you mentioned, that yes, there's a lot of competition, but it has retained the top spot, and it's a really important product for Ford. Why has it been so successful on such a sustained basis?
I think it has to do with America. The pickup is sort of a creation of ours, right? And I think that harkens back to our sort of hardworking, heartland type of imagery that we have. And what's happened now is that pickups have become cool. It's not cool to have a big SUV now. It's cool to have a pickup when you go to the mall or when you go to go out at night. So it's strange how the phenomenon sort of took place, especially when the gas price is so high, like around 10 years ago. Now they're below $3 a gallon. So now it's kind of not only cheaper, but cooler.
Prash, you will know pickups have jumped the shark when you see people in New York City and Chicago driving pickup trucks. But we got to say thank you right now.
Thanks, guys.
All right, we are going to be back and check markets right after this. Welcome back to Yahoo Finance on the Move. We're watching market sell-off. A lot of this is because of the new reports of coronavirus cases surging, Texas rolling back its reopening, and then we got the run rates for new cases out of Arizona well above their 7-day average. So as we pay attention to that, one of the things that researchers are able to do is to draw upon free data that would have taken years to aggregate in the past and now take roughly seconds. One of the organizations behind making that possible is C3.ai, and the founder and CEO, Tom Siebel, is joining us now to help us how their partnership in the Digital Transformation Institute, along with Microsoft, is helping all of us with this kind of research. Welcome to the program, Tom.
Good morning.
So what is this in essence really about? Is it researchers really can go into the cloud and get data for free that would have taken years to compile in years past?
Yes. So what we have done at C3.ai, we spent the last decade building this software engine that's used for industrial and commercial scale AI applications. And one of the requirements of those applications is to aggregate very large data sets, disparate data sets into the unified federated image. So as this crisis unfolded in a, say, February, March, April timeframe, many organizations around the world began to publish very large data sets, Meyer Corporation, Johns Hopkins, World Health Organization, CDC, et cetera, about the course of the disease in China, in India, in Korea, comorbidity, the shape of the curve, mortality rates, infection rates, what have you. And what we have done is we have taken the union of all those data sets and aggregated those data into a unified federated image. So this is the largest corpus of data about COVID that's available on the planet to our knowledge. And weather data, climate data, census data, course of disease, comorbidity, et cetera. And we have published that image as a free utility to researchers around the world to be able to understand the course of the disease and hopefully come up with well-informed, data-driven models that will result in better informed policy decisions.
Hi, Tom, it's Julie. So as I understand it, you all aggregate and then researchers around the globe can then analyze. Do you know what, if any, has actually come out of that analysis thus far?
Well, it's been, this has been going on now. I think we initially published this about 6 weeks ago, and we update it every 2 weeks. And so there are thousands of people who are accessing it every day. We have not seen the results yet, but I expect to see results. And these are, some of the foremost research institutions on the planet, including pharmaceutical companies, technology companies, research institutions like MIT, Berkeley, what have you. And it is unquestionable that very soon we will see solid data that will inform, I think, better policy decisions. I mean, we're in the midst of the largest social experiment right now at a global scale since maybe the Bolshevik Revolution. And, that was informed by not very well-grounded economic theory. And these decisions that we're making are informed by virtually no data at all. These are, I think, primarily political decisions where people are whipsawing back and forth, and the economic, social, and personal costs are pretty substantial. So I think it's incumbent upon all of us to study the data, understand the data, and make well-informed policy decisions.
Well, Jared Blicker here, by the way, just to follow up on that, how long do you think it's going to take to acquire enough data to actually make informed decisions rather than simply political ones? And then the second part, I know your institute originally focused on anonymizing data. Is privacy part of your concern as well?
The Digital Transformation Institute is a coalition of a number of major research institutions around the world, Stanford, Berkeley, Illinois, Carnegie Mellon, MIT, Princeton, what have you, that is doing advanced research using the C3 AI data lake on development of AI techniques. The initial call for papers is development of AI techniques to mitigate the spread of pandemic, including the COVID, understanding the course of disease, understanding the efficacy of various interventions, infection rates, mortality rates, what have you. As they do, the Institute will be doing additional calls for papers every 6 months. I think they've just funded about $6 million worth of work last week. But definitely ethics and privacy are on the agenda as critically important issues as it relates to digital transformation. So I'm confident they will be sponsoring extensive research in those areas.
Tom, I have a question just about the broader software space since you've worked for so long in that arena. And I'm wondering, when you take a look at some of the publicly traded companies out there, given the run up that these stocks have had recently, which of them do you feel are providing services that are going to be the biggest value add in a post-COVID economy?
Well, I think that in a post-COVID economy, we're seeing a massive rush to digital transformation as companies reinvent themselves. I mean, you mentioned Royal Dutch Shell earlier. They are in the midst of reinventing themselves writ large. And this is a company, we look at the oil and gas industry, very few companies can make money at less than $45 a barrel, maybe only one, Saudi Aramco. And so these companies like Royal Dutch Shell are forced to either reinvent themselves or slowly go out of business, and they are reinventing themselves writ large. So, any technologies that help fuel this drive towards digital transformation, I think are, adding enormous value, and that would certainly include Microsoft. I mean, they're way out in front, I think. The cloud providers like Azure, AI providers, analytics providers, people who have technologies like this technology here that enables us to collaborate virtually. I think all of those are kind of big winners in this new economy.
C3.ai founder and CEO Tom Siebel, we appreciate your being here on The Move, and should point out that your company's been around more than a decade selling the software for predictive analytics. And I think a lot of people are appreciative that you're part of this free effort to help us with COVID-19. All the best to you.
Thank you.
When we come back, not just predictive analytics, but Jared Blickery, he's going to help you predict some things with the markets and how you can get in on that when we're back. Welcome back to Yahoo Finance on the Move. We're going to go to Jared Blickery to see what's happening with the markets. But as I throw it to you, Jared, I want everyone to know that you're going to host a webinar, Trading Stocks and Managing Risks in the COVID-19 era. That is going to be Wednesday, July 1st at 2 p.m. So a lot of people are going to want to tune into that.
Thank you, Adam. And it is risk off today. And we're seeing financials leading the way down after the Fed said dividends are going to be capped for a little while and buybacks are going to be halted throughout at least the third quarter. So let's take a look at some of the charts here at the Wi-Fi Interactive. Dow's off 563 points, more than 2%. NASDAQ slightly better at 1.37% down, and the S&P 500 down about 1 2/3%. And here's a look at the 5-day price action for this week. You can see that we have undercut the lows from Thursday, and just broadening this out to a 2-month chart, you can see still hovering around that 200-day moving average. A close below that, especially a close below 3,000, would probably be a negative development that leads to some additional selling next week. We do have support around 2,800, and that would be down here. So we'll have to keep an eye on these price levels. Also want to take a look at the 10-year T-note yield because that has dropped to 64 basis points. That is the lowest in about 1 month here. 65 basis points, just one above was a support level. And we are seeing the yield curve contract as well. Also seeing a dollar strength trade going on. Not any big moves just yet, but this is the third day in a row that we're seeing some gains in the dollar. And we could be heading up to the top of the range, 100, 101 that we saw prior in the year. Also going to take a look at crude oil. That is going to end up down on the week, but it has had a nice run here. This is only the second down week in the prior 9. And just think, we went from -40 to $40 a barrel. Want to highlight our Yahoo Finance Premium idea of the day. That is Accenture, and that comes via Argus Research. They now have a price target of $235. Adam?
Jared, thank you. When we come back at Yahoo Finance on the Move, we've got Ian Bremmer from the Erasure Group. We'll be right back.
From the Federal Reserve that are going to bar buybacks in the third quarter and cap dividends for the nation's banks. Those bank stocks are helping lead declines. But we also, of course, have new headlines on coronavirus cases and Texas, which has been acutely affected over the past several weeks. The governor there, Greg Abbott, said he's not just pausing reopening, he is rolling it back. He said all bars that receive more than 51% of their gross receipts from the sale of alcoholic beverages are required to close by noon today. In Florida, COVID-19 cases are up 7.8%. That's above the previous 7-day average of 4.1%. In Arizona, we are seeing a similar jump. We got some economic data today. Personal income in May down 4.2%. That was better than estimated. Consumer spending rebounded, gaining 8.2%. And on the specific company front, we have the IPO of Albertsons, the grocery store chain today. The company sold shares at $16 a piece, raising $800 million. However, today, as it opens, it is trading below its IPO price. We are going to be joined by the CEO of Albertsons this hour. Let's talk more about what's going on in the markets today. For that, we bring in Michael Sheldon. He is the executive director and CIO at RDM Financial Group at Hightower, and he's joining us from Westport, Connecticut. Michael, it's good to see you.
Thank you very much.
So we've got this pullback today, which seems to be a combination of the banks and some of the coronavirus data. I know that you're also watching the economic numbers closely. And as I mentioned, the numbers today weren't bad, right? Consumer spending in particular rose by 8.2%. I guess the question is how sustained some of these increases in spending that we've seen can be. What do you think?
Well, it's interesting. I mean, a common question we get from clients all the time, we're a registered investment advisor, is why is the market rising while the economy is really not doing that well? That sort of fits in with your question. So, I mean, historically, if you look back at a lot of the data, the markets tend to bottom before the economy does. So we know for a fact, for example, that second quarter GDP is going to be really terrible. Corporate profits are going to be very weak. Retail spending is going to be very weak. But in our opinion, we probably hit the lows back in probably about April or so. And third quarter numbers will look better than second quarter numbers. And next year's data overall, even though it's not going to be off to the races, next year's data will likely look better than this year's data. So markets are looking ahead. And overall, we are seeing a little bit of a pullback in the market today. I think that's only reasonable after the strong advance we've had over the past 3 months or so. But I think you have to look ahead at the next 12 to 18 months or so, as opposed to just the next week or two.
Michael, if you do look ahead, though, and a lot of us are hoping we did bottom out in March, April, May, April. When we see Texas rolling back its reopening, if this phase of the coronavirus gets worse and then we get the anticipated second wave, what's to prevent further rollback and then, a kind of slowing down of that which you think is going to propel us forward?
Sure. Well, the spread of the virus or the increase in a number of states recently is definitely disconcerting. And I think the important thing is we never really thought it would be a straight line forward. There would be some bumps along the way. We had a number of risks that we were thinking about. One of them is the additional spread of coronavirus in the fall. I didn't think it would really come out this soon, but it actually is starting to come up in a number of states. We are looking at other risks. For example, the relationship between US and China is obviously not doing that well. And then we also have the election later this fall. So there definitely will be some bumps along the way over the next few months.
Hey, Michael, Rick Newman here. One of the things I've been paying attention to is the number of businesses whose existence is threatened. I mean, if the stimulus runs out or doesn't get the job done, and we could have, I've seen projections of nearly 1 million failed small and medium-sized businesses. Now, these are not represented in the S&P 500 exactly, but they represent a lot of demand and a lot of employment. Is that part of your scenario?
Well, I think the PPP and the part of the stimulus plan that was passed a few months ago tried to address small businesses, which are certainly a major important part of the economy. A large number of jobs are derived from small businesses. One of the risks is that the number of people who have been unemployed does not come back as quickly as projected over the next several quarters or so. And that's definitely something that will need to be watched. The $600 in additional money going to people who have been unemployed rolls off at the end of July, and there's a lot of questions about whether that will be renewed or not. Our feeling is that there'll probably be another stimulus plan out of Washington. So far, we've seen about $6 to $7 trillion in spending from both the government and monetary policy to help really provide a bridge until the economy gets back on its feet. But if we don't get additional money out of Congress, that definitely could lead to slower spending and more uncertainty in the fall for a period of time.
Hey, Michael, Kristen here. So I want to ask you about recovery. It wasn't too long ago that we were talking about V-shaped recovery, very deep V, but a V-shaped recovery nonetheless. If we start to see this second wave, states start to go back into that lockdown, what exactly do you think is going to be happening to the recovery going forward?
Well, as you said, there are a lot of questions about a V-shaped, a U-shaped, an L-shaped. There may be some others. I've heard a square root as well. Our thinking is that again, the economy likely hit bottom in April, and we're starting to see some pretty strong data right now, but that's after a big downturn in the economy. One example is the retail sales numbers, which came out last week, and we're up about 17% or so, which was an all-time high. But that's after we already saw some significant weakness. So I think when you look at the data, we're going to see the economy started to open up. And obviously, we're starting to see a little bit in the way of rollbacks in some states, but because the economy is starting to open up off a very low base, third quarter GDP and third quarter economic data will look pretty strong compared to the second quarter. From there, the question is what the economy looks like in the end of this year heading into 2021. So at this point, I think there are a lot of question marks. Our feeling is that the economic growth will not be as robust as some think. I think a V-shaped recovery where we're off to the races for a number of quarters is probably unlikely, but so we should see some more sluggish growth, but still growth as we head into the end of the year.
Michael, because some of your reservations about what the growth trajectory is going to look like, you're recommending that people stay diversified. We've been hearing that refrain quite a bit, actually, from investors over the past several weeks. But what does diversification look like to you?
So we're investment advisors, and we create a financial plan, and then we figure out the rate of return that clients need to meet their long-term objectives. So then we create an asset allocation that each client can live with over the ups and downs, which inevitably come with investing. So in our portfolios, we think you have to have some technology that represents secular growth, and you need some growth within your portfolios. Technology is benefiting from a number of trends. We like things like 5G and artificial intelligence and robotics, software as a service. The spread of e-commerce is certainly a trend that's going to continue. And then we also like, on the GARP side of our portfolios, we like healthcare, sort of growth at a reasonable price. So within that, we have some other things sprinkled in, like biotechnology within healthcare. We like financial payments, but that's all sort of within a broadly diversified portfolio.
Michael, thank you so much. It's good to see you. Michael Sheldon is RDM Financial Group at Hightower's Executive Director and CIO. Thank you.
Thank you.
Let's dive back into the details of coronavirus and the recent surges in cases we've seen in various areas, and also how the United States has been handling it. We're joined now by Ian Bremmer. He is the Eurasia Group founder and president. He's joining us from New York. Ian, it's good to see you again. So what do you make of these recent surges we have seen and the various states now having to roll this back? Investors are telling us that perhaps this latest wave is not as detrimental to the economy as the first.
Probably not as detrimental, at least not in the near term, because it's much harder to actually close down the economy. I mean, Texas just a few hours ago took some steps towards rollback, but certainly not full lockdown. I think a lot of other governments across the country, despite significant explosions in cases and in hospitalizations, though not yet in deaths, are going to be cautious, but it's very different from saying they're going to go and lock it down. And so that does imply that the economic hit near term is not going to be as grievous, but the human hit is real. And it's very clear that we do not have anything like a unified response. We're not leading with science. There's much more cheerleading coming from the top of the US government than there should be. And we're not learning from our own bad experiences in terms of the necessity of social distancing, the necessity of wearing masks, which has become a politicized issue in the United States. And that's not true of any other advanced industrial democracy in the world, but it is true in the United States. And so you saw, okay, only 6,000 people showed up in Tulsa for President Trump's much ballyhooed rally this weekend, but less than 10% of them were wearing masks. including the president, including his advisors. That sends a very strong message to the rest of the country. Don't have to worry about this anymore. For 2 weeks, we were all focused on Black Lives Matter, and most of the media channels were not talking about the concerns about no social distancing on the streets with tens of thousands of people chanting in comparatively confined spaces. Now, that doesn't mean, saying that doesn't mean you're opposed to Black Lives Matter. It means that science, you've got to, it is a pandemic. And so the idea of leading with science means no matter who you support politically, first and foremost, you make sure you have a consistent message about the disease, about how to maintain safety. And we're not doing that in the United States, not even close.
Okay, so you've just brought a lot of this, but it all kind of coalesces around the message from the White House. And you have sources at the White House and at the top levels of government. What are they telling you about that maybe lack of leadership? And can you put the genie back in the bottle? I mean, the impact on everything, whether it's markets, whether it's consumers, it starts at the top. So can they get on top of this?
Well, I mean, one, you can't only blame the president. You do have to focus on governors. You do have to focus on Democrats and Republicans in office in Congress. You do have to focus on the media and how they've mishandled this, in my view. So from your question, I don't think you were asking this, but I just want to be clear. I think it would be incorrect to say everything that's going wrong is because we hate the president and he's an incompetent. But you asked me specifically about the White House, and I will say that in an election, and yes, it's really unfortunate this is happening in the teeth of a very divisive election because it makes it worse. They understand that the only thing that Trump is consistently beating Biden on right now, and he's beating him by a significant margin, by well over 10 points, is on the economy, handling the economy. And that if this election is about coronavirus, they think they're going to lose. They're probably right. So Trump and the White House is focused on we got to talk about opening up. We got to talk about confidence. We got to talk about getting people back to jobs, right? And to be fair, I mean, the economic response in the United States thus far, politically, from the Fed and from the House and Senate, both sides, Democrat and Republican, has been fairly robust and fairly early. As opposed to the healthcare response or the PPE response or the education of doing the right thing response, which has been a freaking disaster in the United States. So, yeah, I think the fact that Trump understands that his way to win, his pathway where he is down about 14 in the national polls right now, which is not a good place to be 4.5 months out, though Dukakis was even worse than that after the Democrat convention. I think he was down 17 at the max. So it's not like, it's not over by any means. But the focus on the economy means that you're not going to see Fauci out there the way he was, or Birx out there. You're not going to see the coronavirus task force. You're not going to see Trump paying as much attention to what people need to do or supporting new lockdowns, not for a second wave, but the first wave that we are still very much in Southern California, in Florida, in Arizona, in Texas, very populous states where we're adding a hell of a lot of caseload. And one final point I want to make, people that are not saying don't worry about this are saying, well, not many people are dying. And first of all, death is a lagging indicator. I mean, there's a quote for you. We're not going to see people dying for several weeks until after they're hospitalized. Let's hope that the death load remains quite low, but we do not know what kind of long-term health indications young people that get this virus that aren't being hospitalized are going to have to live with. We don't know if they're going to be treated like smokers. If they're you're a smoker, you're taking 5 years off your life. We have most physicians out there are quite concerned, given what happens to your lungs when you get this coronavirus, well, what that could mean for you long term, and the cost of that on the American economy and on the human capital of the United States is immense, and no one's even thinking.
We hear it. No, Ian, we hear everything you're saying, right, Kristen?
Yeah. So, Ian, I was wondering, you're talking about essentially how much politically the president is taking a hit because of coronavirus. So then we're talking about stimulus that's coming to an end in July. Do you see the White House sort of pushing forward some sort of initiative or supporting, trying to shove more money at the American people to buoy that support all the way through November?
I absolutely do. And I see the Democrats doing that as well. I would be stunned if we don't get well over $1 trillion in additional stimulus by the end of the summer. Certainly unemployment is going to be ghastly high through elections. And, right now you're going to have the unemployment benefits that were topped up are going to be running out. You're going to have a hell of a lot of companies, particularly small and medium enterprises, that are going to be facing bankruptcy. You're going to have all sorts of companies that can't pay their ongoing rent, their utilities bills. This has a knock-on impact on the broad global economy. We're nowhere close to out of the woods on this. So I can't imagine that the U.S. government is gonna let that hang. It's going to be very divisive over exactly what is inside that bill. I don't think we're going to do long-term infrastructure in a meaningful way, for example. But yeah, I think a lot more money is going to be thrown at the American economy.
Hey, Ian, can I take you to China for a moment? There's all kinds of trouble with the trade deal with China, Hong Kong, tensions relating over that. Do you think the trade deal will even still be intact by Election Day? And if it's not, will it matter?
I mean, Rick, not only can you not take me to China, you can't even take me to Europe or Canada right now because those countries are refusing to allow Americans in. That's what happens when you don't handle the coronavirus. Do I think the phase one deal is going to be intact? Navarro doesn't. He made that, the senior advisor on trade, the White House made that statement on CNBC. Markets futures go down a few hundred points. And within an hour, Trump tweets, oh, no. I mean, he got slapped both sides of his face, Navarro, right? That must have hurt. Deal's still in place. I mean, U.S.-China relations are certainly getting worse on almost every front, on South China Sea, on Taiwan, on Hong Kong, certainly. And you see a unanimous vote coming down in Senate today for tougher sanctions against Chinese officials because of the stripping away of autonomy of Hong Kong. You've got more sanctions coming down because of the Uyghurs. You've got technology issues, the Canadians getting caught up in that, and the Huawei arrest, and the moving towards extradition of the daughter of the founder. I mean, you cannot look at an issue between the U.S. and China right now that is moving in a good direction. There is not.
So is all of that an electoral issue, or is that kind of going over voters' heads?
Oh, no. It's. I mean, the election doesn't help. But I mean, when you have 100 members of Senate, 100 members supporting additional sanctions against the Chinese government for Hong Kong in a maximally polarized environment, that tells you this is not an election issue. You are very hard pressed to find anyone on the Hill right now that says we should be softer on China. Now, President Trump clearly understands that a hard line on China is particularly useful to distract from his own missteps around coronavirus. And blaming the Chinese and even using racist terminology for coronavirus itself is part of that strategy. He knows what he's doing. But if you could magic up Biden as president right now, the trajectory of the relationship would still get worse. The interesting thing is, despite all of that, Trump is holding on to this phase one trade deal, and it's because he knows what it's going to do to the markets if it blows up. And that's despite the fact that the Chinese are not going to come remotely close to executing on the deal that they signed. I mean, they're not going to buy the American ag that they promised this year, and Trump is still giving them a pass. Now, the advisors I've spoke to in the White House, including some very senior ones, are telling me that on balance, they think the deal will not last through the election, but it's very close. And ultimately, that decision is going to be made by one guy, and it ain't those advisors.
Ian, I also want to ask you about one more issue and how it's going to play into the campaign as we head toward the fall, and that's the protests and the Black Lives Matter movement and the push for racial equality in the United States, where President Trump has not polled well. He's not done a good job by many measures. Do you think that the protests are going to have enough staying power that is going to continue to be an issue for him as we get closer to the election?
I don't know. I mean, I don't think Trump is in any danger of winning the black vote. I think we can be clear on that. The fact that the House and Senate have been unable to come up with any compromise on police reform. I mean, it kind of reminds you of Newtown and gun control. And there, Obama was very strong, and Biden, then vice president, was very strong, and they got nothing done at the national level. So I think Black Lives Matter has lots of legs. It does make an impact, but largely in changing policing practices, funding, training, litigation against police, more transparency at the state and at the local level. That's where you get movement. That's meaningful movement in the United States. It's a good thing that we have a federal system. That's what's happened on gun control too. But is that enough to keep them going through November? You know, especially when the economy is coming back, when the weather is not as nice, when people are at work, maybe when some schools are open. I mean, part of the reason this exploded is because there's massive structural racism in the US and because these videos were so viscerally horrible to watch. But part of it is because a whole bunch of people, especially Black Americans, but also all of us, have been cooped up, many of which unemployed at home for a few months. And suddenly, you know, you've got something to go and mobilize for. Screw it. I'm on the streets and I was scared even to talk to people, but this matters more. I can now get out there. And I mean, it is, again, I can't say enough. You know, we're now watching in Los Angeles County explosion of cases where just yesterday, the head of public health for LA said that significant pieces of that are linked to these tens of thousands of people tightly packed that were protesting in favor of Black Lives Matter.
Right, although we haven't seen that explosion in other areas, right? And there have been some various explanations in that. We have to leave it there, Ian, but it's always really great to get some time with you, and we will hope to see you again soon. Ian Bremmer is the Eurasia Group founder and president. Take care, Ian.
Yeah.
All right, we'll be right back. Tuesday, June 30th, there will be a new regulation being put in place that aims to better protect investors. It's called Regulation Best Interest, and it will affect broker-dealers and basically require a bit more transparency and them putting clients' best interests front and center. It's similar to regulation that already affects financial advisors. Joshua Mitz is joining us now to give us some perspective on all of this. He is Columbia University Law Associate Professor of Law. He's joining us from New York. Joshua, thank you for joining us. So This
Thanks
is
for having me.
in many quarters as good news, right? That this is going to help investors. But that is not a universal perception. And I think you share the perception that there are perhaps some disadvantages of this new rule. Can you explain for us?
Absolutely. Well, again, thanks for having me. So, when the SEC set out to put this rule in place, they had in mind some really troubling practices that had emerged in the broker-dealer industry. I'm sure many of us remember Bernie Madoff. There's a long history of brokers taking advantage of their customers. So what the SEC did in Reg BI is to say that broker-dealers, E-Trade, you name it, have to follow this standard, which says they must put the best interests of their customers first. That's a terrific development. I think it's been universally praised and rightly so. The problem is that at the same time that they passed this rule, making it a higher standard, if you will, for broker-dealers, they also lowered the legal standard that investment advisors have to follow. Now, investment advisors, your Vanguards, your BlackRocks of the world, really are such a central part of the investment landscape. If you think about the average American who has a 401k plan, it's very likely that they have their money not with a broker. They're not trading on E-Trade, but they're entrusting their funds to Vanguard. And many folks, including myself, are concerned that what the SEC did was make it easier for investment advisors like the Vanguards of the world to intentionally or not take advantage of their retail customers.
Was it a solution in search of a problem?
I think on the investment advisor side, that's exactly right. We had in mind all kinds of cases of brokers exploiting their customers, and the SEC was right to take aim at that. At the same time, there was heavy lobbying by the investment advisor industry from the proposed to the version of this rule to the final rule. And what they basically said was there should be one standard. And what this standard did was more or less switch the order of what has to be put first. So in the past, if the investment advisor was going to do something that would in some way not put the client first, the investment advisor was not allowed to do that under prior law. Following Reg BI, the investment advisor is allowed to take actions that are equally beneficial to both the advisor and the client. Now, that might sound harmless in practice, but there's a lot of money that's made on Wall Street executing trading strategies that take advantage of retail investors. Those kinds of trading strategies are expressly permitted by the text, in my view, and in the view of many other securities law professors who've looked at this by Reg BI.
Joshua, Kristen here. So we know financial advisors have to have this fiduciary standard to their clients. Not seeing that here with brokers. Do we need some sort of legislation across the board, some sort of standard that will apply to both financial advisors and to brokers as well?
So one of the great developments, and one could say, in my opinion, at least in the wake of Reg BI, is that several states have already taken steps towards ratcheting up the fiduciary standard and saying, no, you shouldn't be able to trade in front of or against your clients. This kind of front-running practice that is quite popular on Wall Street. That's been an encouraging development. We've seen this in Massachusetts. We've seen this in other states. The problem is that we have 50 states. We need the SEC to put in a uniform standard, but there's also a question as to how the courts are going to view these effectively conflicting standards. It's an open question. There's a lot of litigation right now, but it has been encouraging to see at the state level, investor protection receive greater priority and greater attention.
I want to ask you a question about Volcker 2.0, the loosening of some of the restrictions that we had seen before. I mean, when we talk about news coming out of the banks, it seems that Volcker 2.0 is essentially going to put the onus on the banks themselves to create more control, more limitations. We have seen historically they have not been that great at doing that. Should we have the confidence in them now with Volcker 2.0 that they are actually going to put those controls and limitations in place?
It's a great question. The Volcker rule has long been a controversial one because it has in fact reflected what some on the more conservative side of this political spectrum have said is a kind of paternalistic approach to regulating the safety and soundness of our banks. A particularly interesting aspect of the latest iteration that was just passed yesterday, what is the venture capital fund rule, which allows banks to take positions in VC funds. Now, all of us know venture capital is a highly risky part of the investment ecosystem, and most startups, for better or for worse, are going to fail. But what the industry argued is that banks today can take a position in individual startups. What they can't do under the prior Volcker rule is invest in a fund which spreads its capital in a diversified manner across the several venture capital targets, several startups. So what in effect the banking sector is saying is, be less paternalistic. We're allowed to take some of these risks. Let us take these risks in a more diversified and safe manner. The response on the left has been, how can you call venture capital safe? It's anything but.
Fair point. Joshua Mitz, thank you so much for your time. You are an associate professor of law at the Columbia University Law School. Appreciate it. I wanted to bring you some breaking news on the Facebook advertiser boycott. Another large company has signed on to that boycott, and that is Unilever. Remember, it's unit Ben & Jerry's, the ice cream company, had already signed on to the boycott. Unilever also owns other brands like Hellmann's, mayonnaise, Lipton tea, Dove soap, and the executive vice president of global media said in an interview with the Wall Street Journal, based on the current polarization and the election that we are having in the US, there needs to be much more enforcement in the area of hate speech. That Unilever joins companies like Verizon, our parent company, Patagonia, and North Face in joining on to this boycott. Well, our Julia LaRoche sat down with Mark Benioff to talk about the growing importance of companies providing mental health services for their workers. He, of course, is the CEO of Salesforce.
Right away, 1/3 of all of our employees have reported that they have mental health issues at home, many of the things that you mentioned, and we needed to go right into action. And so every single day we've done a Salesforce Be Well call with all of our employees just to help them do mindfulness exercises, help them to reconnect with others, to help them pay attention to not just their physical health, but their mental health. And in fact, it's become so popular now that we've had to open it up to all of our customers, even the whole world. You can now attend just a Salesforce Be Well course, which is something that we're doing almost every single day. Let me tell you a couple more things that we've had to do. We've had to do all hands calls. Every Wednesday, I'm on a call with all of our employees. You know, we have 52,000 employees. It's not unusual for half of them to be on this call. That's amazing to me. We haven't done those types of calls since we were a startup, like you mentioned, 20 years ago. And a third thing that we've done is our Leading Through Change series. We've now had more than 100 million views of Leading Through Change, which is helping present our opinion of how to be successful during this incredible moment. So there's many things that we have had to do to get productivity back with our own Salesforce. It's very important, and with all of our employees, I should mention. That is, we're trying to get everyone from paralysis into participation. We're trying to enable and to train everyone in this new world. We're trying to increase our relevance, which is why Work.com is so important and Salesforce Anywhere is so important. And I'll tell you, they also need very tactical plays on how to behave and how to act in an environment like this. Very specific training on here's how to be successful in this world. Ultimately, it's about customer success. We have to help get that customer success to happen. But doing all of these things, that is the way to make it happen.
on the lows of this session right now. The Dow is off 2.4%, and the NASDAQ and S&P 500 both off about 2%. This as we see rises in coronavirus cases in various states. And we also continue to contemplate what it will look like when we get back to our offices. We're allowed to in some places, including in New York City in some capacity. We are joined now by Craig Bender. He is ING America's Commercial Real Estate Finance Head. He is joining us from Westchester. So, Craig, there has been a lot of talk about people staying home, even when this is all said and done, particularly in urban, heavily trafficked areas where you have to take public transit. What do you think, and what are you hearing from your clients?
Well, first, Julie, thanks for having me on. It's interesting. We work with a lot of the largest landlords in New York and across the country, and clearly working from home is working today. The technology is working, the communication, but we have to think about it in the long run, right? I mean, I think when you talk to tenants and people who survey their employees, there is a desire to get back into the office. Now, will there be a certain portion of employees who decide, hey, this is working for me and I'm going to stay at home? I think that's right. And I think to a certain extent, we've had that flexible arrangement in a lot of workplaces. But, think the office is more than just a desk and a computer, right? The office is a way for companies to brand their business. It's a way for companies to attract talent. Training is a huge, important part of being in the office. This is very difficult to train junior staff members with a completely distributed workforce, right? And being in the office brings us closer together. We need to be near our clients. We're social people. We need to be building those types of relationships, both internally within the organization for the younger people who want to grow within their firm, and also externally when we need
Craig,
to be. Yeah, go ahead.
If I'm an employer or a company, I don't need nearly as much office space as I thought I needed going into the pandemic. And isn't commercial real estate going to take a hit because of that?
Adam, I'm not sure about that, right? So over the last 10 years, commercial real estate offices have densified, right? We went from 225 to 250 square foot per employee down to about 150 square foot per employee. And we really pushed the limits. And even before COVID, you saw office users undensifying their space a little bit. This is going to exacerbate that. Okay, so if you need another 50 square feet per employee, 25 to 50 square feet, you need about 20 to 30% more space than you currently have, considering the workforce that you have today. Now, if 10% works from home, 15% works from home, you might be breaking even, right? I just don't know. There's some competing factors there, Adam, that we just don't know. And when we talk about values in commercial real estate, there's of course the cash flows and the credit quality of the tenants that are in our buildings. But there's also still a tremendous amount of investor demand for commercial real estate, especially in cities like New York, from investors across the globe that are chasing yield because of the interest rate environment. The yield requirements thus far have not really changed from investors because the base rates, the treasury rates have really dropped to a very low level. So you're looking at a spread between treasuries and yields on core office properties of 400 to 500 basis points. It's pretty attractive when you compare that to bonds and whatnot. And there's room there to compress, and there's room for softening of cash flows and to perhaps maintain values. I mean, we've seen a little bit of a correction in values, say 5 to 10%. It's just too early to know exactly how it plays out in the long run. But what I do feel strongly about is that the office is not going away. It's not catastrophic.
We hope not. There are a lot of us want to get back to the office, right,
exactly.
Kristen?
So Craig, I was reading your note, just before, and you said that the office might actually become more important now after coronavirus than before. But we are seeing company after company after company essentially say, listen, employees can work from home forever if they want. Yep. Do you think that a lot of companies are going to essentially come to the same conclusion that you are, that the office space is actually needed? Because it seems that the trend is going the other way.
You have to look behind the headlines a little bit, right? I know Mark Zuckerberg said, in 5 to 10 years, 50% of his employees are going to be working from home or in various cities across the country. But let's think about that a little bit, okay? Mark Zuckerberg is on a hiring frenzy for Facebook. He can't hire enough people. He's looking at places, and rightfully so, other cities around the country that have really talented employees that might benefit and add value to Facebook. At the same time, Mark Zuckerberg, who just signed a 1.5 million square foot lease in Hudson Yards, is looking at additional space very seriously at Vornado's Farley Post Office project, and is also rumored to be looking at additional space in Hudson Yards. So I just don't know that, when you dig into the details, that, we're really seeing a complete shift and paradigm shift.
Hey, Craig, Rick Newman here. So when you talk about the densification trend over the last several years, basically putting more people in less space, that was basically the death of the office, the space with a closed door. Everybody now works in a common area. That's a problem with coronavirus. So is there any chance, have you seen any interesting designs or thoughts about how to sort of reestablish little offices or anything like that?
I think we're going to see de-densification. We're going to see spreading out of employees more. We're going to see more partitions, perhaps. And office building owners are going to innovate. They always do. They're going to invest in their projects. We have a building that we're involved with now. They're going to completely touchless entry points. They're putting in hospital-grade ventilation throughout the building. All kinds of things to sort of make their assets sort of really competitive in a post-COVID world. And we're going to see a lot of that in the major cities and from the big office owners.
You think it's going to be better for workers or worse? Partition sounds antiseptic and terrible.
Yeah, there's some really creative design out there. We can see glass, we can see, and I think it's less about partitions and more about just spreading out and not having employees right on top of each other. And that's where we are. And I think that's we're going to shift a little bit away from that.
Craig Bender is ING America's Commercial Real Estate Finance Head. Craig, thank you so much. Appreciate it.
Thank you for having me.
Wanted to bring your attention to the movement in shares of Facebook. It is down sharply right now, and that's after Unilever announced it was going to be the latest company to sign on to the pledge to stop advertising on Facebook. By the way, many of those companies said they would stop as of July 1st for at least a month. Unilever is saying it's stopping for the remainder of the year. So this movement gaining some momentum. And just quickly, I want to mention Albertsons. It's having its IPO today. We're going to talk to the CEO next. Albertsons made their trading debut today. The company held its initial public offering, pricing shares at $16 a piece. Right now, they're little change, down by less than 1%. The ticker, by the way, is ACI on the company. And we are joined now by the CEO of Albertsons. He's joining us from Boise, Idaho. That is Vivek Sankaran. He is, again, the CEO of the company. Vivek, thank you for joining us. I'm curious about the timing here of having the IPO. I know that Albertsons has made some attempts in the market in the past. What led you? What was the catalyst this time around?
Julie, first, thanks for having me on. The last time we tried to IPO was in 2015. There was a set of circumstances, and it didn't go well. It's always so hard to time the market, as you know. But in 2015, we brought Safeway and Albertsons together, and we've spent the last several years just integrating the companies and modernizing it. So there's a lot of us that's traditional, but a lot of what we have is also very modern with the technology that's behind it. And so we felt in many ways we were ready for the IPO. And as we went through the first few months of the year, we also got the sense that the markets are ready for the IPO. And that's why we did it. And we're delighted that it worked.
Who doesn't like food, right? But
Yeah.
I got to ask you, I mean, it's such a hard business, grocery stores, supermarkets, and the food business, especially now. I realize that the coronavirus pandemic, we are all hoping will be a short-term 1-2 year issue in our lives. But food prices right now, what are you seeing within your operation? Is it meat prices that are going up? Is it canned goods? Where are the price increases?
Yeah, Adam, we are seeing more inflation than we're used to in the food industry. It's a lot in the meat side of the business, and some in the produce, but there's generally in the fresh area there's been some, and it's driven more by people are eating a lot more at home, right? People are eating a lot more at home. Supply chains don't shift quickly enough to grocery stores versus away from home consumption. So while there's some demand, there's some supply challenges that come and go, which is driving some inflation. I don't know where that will end up, but I can tell you that from a general supply standpoint, we're starting to see a lot more stability. You can get what you want now in any of our stores.
Hey, Vivek, Rick Newman here. Can you tell us what's coming in your stores within the next 5 to 10 years to compete with some of the stuff that Amazon is rolling out and some other sort of cutting edge retailers, cashierless checkout stores with barcodes that record everything and you just walk out the store, you don't have to stand in line. Are you going to have that kind of stuff in your stores?
Yeah, Rick. So the first thing to recognize is in retail, you always win in the long run because you have a great portfolio of products, and we pride ourselves in fresh. So then you say on top of that, how can you provide more conveniences to customers? And what we're spending a lot of time on first is everything that around delivery, our own trucks, using third parties, having people come in and pick it up, what we call drive up and go. You just drive up and pick it up. And there's a lot of technology that enables that in the background. And then in our stores, we're also expanding we just have now contactless payments. We're introducing contactless registration of your loyalty, so you get the discounts that you want. And we're continuing to advance that. The technology is not yet at a place where you talked about no cashier, the cashierless payment. It's not at a place where it is both either robust or affordable for a store our size, 50,000, 70,000 square feet. It's a long way to go for something like that, but we're always working towards making it easy for our customers.
Vivek, Kristen here. So coronavirus has been essentially a big win for grocery stores over the last couple of months. But what are you guys anticipating after coronavirus is over?
Yeah, Kristen, I'll tell you some of the trends we are seeing. And I think these trends, the longer we are in this environment with the virus, the more likely those are to stick. First, more eating from home. People are rediscovering meals with family, rediscovering baking cookies. So they're just rediscovering cooking. And so that's one trend that we're seeing. And the longer it goes, the more that sticks. The second is work from home. I heard somebody else just earlier on, Craig was on. We are finding, we just did a roadshow on the computer. We did a roadshow, IPO roadshow on the computer. And so we're finding a lot more work from home. And when you work from home, you have more lunches and breakfasts at home. And so we think that people will find a new normal, which would mean eating more from home. even as we come out of this coronavirus crisis.
And a lot more cleaning up at home, unfortunately for me. Vivek, just wanted to ask you finally what you're using the IPO proceeds for. Is it expansion in tech that you're talking about? Is it opening new stores? What's the plan?
Julie, it was all secondary. So we've had investors who've been with us, who put this company together starting in 2006. And the proceeds went to them. We have a new set of investors in, which we're excited about. They still own a large part of the company. But so it was entirely secondary. We've been well capitalized and brought our debt down, so we didn't need the funds from the IPO for the operating side of the business.
Vivek, thank you so much. Vivek Sankaran is the CEO of Albertsons, which held its IPO today. Thank you.
Thank you all. Take care.
We'll be right back. The Affordable Care Act is coming under challenge once again. The administration, Trump's administration, is taking it to the Supreme Court and saying that the Affordable Care Act is invalid, including protections for people with pre-existing conditions. Krista, I know you have been watching this phenomenon. And again, this is not the first time that the ACA has come under attack.
That's right, Julie. So originally, this was a lawsuit that was brought up by the Texas AG, Ken Paxton, who essentially was leading the charge of a bunch of Republican AGs who wanted to declare the Affordable Care Act as essentially unconstitutional. Now, what originally happened was that the White House said, we are going to decline to defend the Affordable Care Act, essentially paving the way for it to go to the Supreme Court. Now, that case had essentially been knocked back, to the courts inside of Texas, which then again ruled that it was unconstitutional, again sending it up to the Supreme Court. Now, what the White House has decided to do was essentially file and ask the Supreme Court to look at it and to file it as unconstitutional. Now, interestingly enough, Julie, this is largely looked at a legal long shot. A lot of people are saying the arguments behind making the Affordable Care Act as unconstitutional really doesn't make a lot of sense. So it's really interesting to see what the Supreme Court is going to say if they decide to take up that case. Now, you have to understand right now, it doesn't look like the Supreme Court is too friendly to the president, as we've seen from a few previous rulings. So it's really unclear if the president is ever even going to get a victory here. But I think what really people are holding on to is saying, look, in the midst of coronavirus, why is the administration right now deciding to strike down a piece of legislation that allows folks right now to